Berkshire's performance versus the S&P 500 annual percentage change. Berkshire Hathaway Inc. To the shareholders of Berkshire Hathaway Incorporated, Berkshire's gain in net worth during 2017 was $65.3 billion, which increased the per-share book value of both our Class A and Class B stock by 23%. Over the last 53 years, that is, since present management took over, per-share book value has grown from $19 to $211,750, a rate of 19.1% compounded annually. Asterisk. The format of that opening paragraph has been standard for 30 years. But 2017 was far from standard. A large portion of our gain did not come from anything we accomplished at Berkshire. The $65 billion gain is nonetheless real, rest assured of that. But only $36 billion came from Berkshire's operations. The remaining $29 billion was delivered to us in December when Congress rewrote the U.S. tax code. Details of Berkshire's tax-related gain appear on page K32 and pages K89-K90. After stating those fiscal facts, I would prefer to turn immediately to discussing Berkshire's operations. But, in still another interruption, I must first tell you about a new accounting rule, a generally accepted accounting principle, GAAP, that in future quarterly and annual reports will severely distort Berkshire's net income figures, and very often mislead commentators and investors. The new rule says that the net change in unrealized investment gains and losses in stocks we hold must be included in all net income figures we report to you. That requirement will produce some truly wild and capricious swings in our GAAP bottom line. Berkshire owns $170 billion of marketable stocks, not including our shares of Kraft Heinz, and the value of these holdings can easily swing by $10 billion or more within a quarterly reporting period. Including gyrations of that magnitude in reported net income will swamp the truly important numbers that describe our operating performance. For analytical purposes, Berkshire's bottom line will be useless. The new rule compounds the communication problems we have long had in dealing with the realized gains, or losses, that accounting rules compel us to include in our net income. In past quarterly and annual press releases, we have regularly warned you not to pay attention to these realized gains, because they, just like our unrealized gains, fluctuate randomly. That's largely because we sell securities when that seems the intelligent thing to do, not because we are trying to influence earnings in any way. As a result, we sometimes have reported substantial realized gains for a period when our portfolio, overall, performed poorly, or the converse. Asterisk. All per-share figures used in this report apply to Berkshire's A shares. Figures for the B shares are 1/1,500th of those shown for the A shares. With the new rule about unrealized gains exacerbating the distortion caused by the existing rules applying to realized gains, we will take pains every quarter to explain the adjustments you need in order to make sense of our numbers. But televised commentary on earnings releases is often instantaneous with their receipt, and newspaper headlines almost always focus on the year-over-year change in GAAP net income. Consequently, media reports sometimes highlight figures that unnecessarily frighten or encourage many readers or viewers. We will attempt to alleviate this problem by continuing our practice of publishing financial reports late on Friday, well after the markets close, or early on Saturday morning. That will allow you maximum time for analysis and give investment professionals the opportunity to deliver informed commentary before markets open on Monday. Nevertheless, I expect considerable confusion among shareholders for whom accounting is a foreign language. At Berkshire, what counts most are increases in our normalized per-share earning power. That metric is what Charlie Munger, my longtime partner, and I focus on, and we hope that you do too. Our scorecard for 2017 follows. Acquisitions. There are 4 building blocks that add value to Berkshire. 1. Sizable stand-alone acquisitions. 2. Bolt-on acquisitions that fit with businesses we already own. 3. Internal sales. Growth and margin improvement at our many and varied businesses. And 4. Investment earnings from our huge portfolio of stocks and bonds. In this section, we will review 2017 acquisition activity. In our search for new standalone businesses, the key qualities we seek are durable competitive strengths, able and high-grade management, good returns on the net tangible assets required to operate the business, opportunities for internal growth at attractive returns, and finally, a sensible purchase price. That last requirement proved a barrier to virtually all deals we reviewed in 2017, as prices for decent, but far from spectacular, businesses hit an all-time high. Indeed, price seemed almost irrelevant to an army of optimistic purchasers. Why the purchasing frenzy? In part, it's because the CEO job self-selects for can-do types. If Wall Street analysts or board members urge that brand of CEO to consider possible acquisitions, it's a bit like telling your ripening teenager to be sure to have a normal sex life. Once a CEO hungers for a deal, he or she will never lack for forecasts that justify the purchase. Subordinates will be cheering, envisioning enlarged domains and the compensation levels that typically increase with corporate size. Investment bankers, smelling huge fees, will be applauding as well. Don't ask the barber whether you need a haircut. If the historical performance of the target falls short of validating its acquisition, large synergies will be forecast. Spreadsheets never disappoint. The ample availability of extraordinarily cheap debt in 2017 further fueled purchase activity. After all, even a high-priced deal will usually boost per-share earnings if it is debt-financed. At Berkshire, in contrast, we evaluate acquisitions on an all-equity basis, knowing that our taste for overall debt is very low, and that to assign a large portion of our debt to any individual business would generally be fallacious, leaving aside certain exceptions, such as debt dedicated to Clayton's lending portfolio, or to the fixed asset commitments at our regulated utilities. We also never factor in, nor do we often find, synergies. Our aversion to leverage has dampened our returns over the years. But Charlie and I sleep well. Both of us believe it is insane to risk what you have and need in order to obtain what you don't need. We held this view 50 years ago when we each ran an investment partnership, funded by a few friends and relatives who trusted us. We also hold it today after 1 million or so partners have joined us at Berkshire. Despite our recent drought of acquisitions, Charlie and I believe that from time to time Berkshire will have opportunities to make very large purchases. In the meantime, we will stick with our simple guideline. The less the prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own. We were able to make one sensible standalone purchase last year, a 38.6% partnership interest in Pilot Flying J. PFJ. With about $20 billion in annual volume, the company is far and away the nation's leading travel center operator. PFJ has been run from the get-go by the remarkable Haslam family. Big Jim Haslam began with a dream and a gas station 60 years ago. Now his son, Jimmy, manages 27,000 associates at about 750 locations throughout North America. Berkshire has a contractual agreement to increase its partnership interest in PFJ to 80% in 2023. Haslam family members will then own the remaining 20%. Berkshire is delighted to be their partner. When driving on the interstate, drop in. PFJ sells gasoline as well as diesel fuel, and the food is good. If it's been a long day, remember too that our properties have 5,200 showers. Let's move now to bolt-on acquisitions. Some of these were small transactions that I will not detail. Here is an account, however, of a few larger purchases whose closings stretched between late 2016 and early 2018. Clayton Homes acquired 2 builders of conventional homes during 2017, a move that more than doubled our presence in a field we entered only 3 years ago. With these additions, Oakwood Homes in Colorado and Harris Doyle in Birmingham, I expect our 2018 site-built volume will exceed $1 billion. Clayton's emphasis, nonetheless, remains manufactured homes, both their construction and their financing. In 2017, Clayton sold 19,168 units through its own retail operation and wholesaled another 26,706 units to independent retailers. All told, Clayton accounted for 49% of the manufactured home market last year. That industry-leading share, about 3 times what our nearest competitor did, is a far cry from the 13% Clayton achieved in 2003, the year it joined Berkshire. Both Clayton Homes and PFJ are based in Knoxville, where the Clayton and Haslam families have long been friends. Kevin Clayton's comments to the Haslams about the advantages of a Berkshire affiliation, and his admiring comments about the Haslam family to me, helped cement the PFJ deal. Near the end of 2016, Shaw Industries, our floor coverings business, acquired US Floors, USF, a rapidly growing distributor of luxury vinyl tile. USF's managers, Pia Doce and Filipe Ramuspe, came out of the gate fast, delivering a 40% increase in sales in 2017, during which their operation was integrated with Shaw's. It's clear that we acquired both great human assets and business assets in making the USF purchase. Vance Bell, Shaw's CEO, originated, negotiated, and completed this acquisition, which increased Shaw's sales to $5.7 billion in 2017 and its employment to 22,000. With the purchase of USF, Shaw has substantially strengthened its position as an important and durable source of earnings for Berkshire. I have told you several times about Home Services, our growing real estate brokerage operation. Berkshire backed into this business in 2000 when we acquired a majority interest in Mid-American Energy, now named Berkshire Hathaway Energy. Mid-American's activities were then largely in the electric utility field, and I originally paid little attention to Home Services. But, year by year, the company added brokers, and, by the end of 2016, Home Services was the second largest brokerage operation in the country, still ranking, though, far behind the leader, Realogy. In 2017, however, Home Services growth exploded. We acquired the industry's third-largest operator, Long & Foster, number 12, Houlihan Lawrence, and Gloria Nilsson. With those purchases we added 12,300 agents, raising our total to 40,950. Home Services is now close to leading the country in home sales, having participated, including our 3 acquisitions pro forma, in $127 billion of sides during 2017. To explain that term, there are 2 sides to every transaction. If we represent both buyer and seller, the dollar value of the transaction is counted twice. Despite its recent acquisitions, Home Services is on track to do only about 3% of the country's home brokerage business in 2018. That leaves 97% to go. Given sensible prices, we will keep adding brokers in this most fundamental of businesses. Finally, Precision Castparts, a company built through acquisitions, bought Wilhelm Schultz GmbH, a German maker of corrosion-resistant fittings, piping systems and components. Please allow me to skip a further explanation. I don't understand manufacturing operations as well as I do the activities of real estate brokers, home builders, or truck stops. Fortunately, I don't need in this instance to bring knowledge to the table. Mark Donegan, CEO of Precision, is an extraordinary manufacturing executive, and any business in his domain is slated to do, well, betting on people can sometimes be more certain than betting on physical assets. Let's now move on to operations. Beginning with property casualty, PC insurance, a business I understand and the engine that for 51 years has powered Berkshire's growth. Insurance. Before I discuss our 2017 insurance results, let me remind you of how and why we entered the field. We began by purchasing National Indemnity and a smaller sister company for $8.6 million in early 1967. With our purchase, we received $6.7 million of tangible net worth that, by the nature of the insurance business, we were able to deploy in marketable securities. It was easy to rearrange the portfolio into securities we would otherwise have owned at Berkshire itself. In effect, we were trading dollars for the net worth portion of the cost. The $1.9 million premium over net worth that Berkshire paid brought us an insurance business that usually delivered an underwriting profit. Even more important, the insurance operation carried with it $19.4 million of float money that belonged to others but was held by our 2 insurers. Ever since, float has been of great importance to Berkshire. When we invest these funds, all dividends, interest and gains from their deployment belong to Berkshire. If we experience investment losses, those of course are on our tab as well. Float materializes at P/C insurers in several ways. 1. Premiums are generally paid to the company upfront, whereas losses occur over the life of the policy, usually a 6-month or 1-year period. 2. Though some losses, such as car repairs, are quickly paid, others, such as the harm caused by exposure to asbestos, may take many years to surface, and even longer to evaluate and settle. 3. Los payments are sometimes spread over decades in cases, say, of a person employed by one of our workers' compensation policyholders being permanently injured and thereafter requiring expensive lifetime car. Float generally grows as premium volume increases. Additionally, certain P/C insurers specialize in lines of business such as medical malpractice or product liability, business labeled long-tail in industry jargon, that generate far more float than, say, auto collision and homeowner policies, which require insurers to almost immediately make payments to claimants for needed repairs. Berkshire has been a leader in long-tail business for many years. In particular, we have specialized in jumbo insurance policies that leave us assuming long-tail losses already incurred by other P/C insurers. As a result of overemphasizing that sort of business, Berkshire's growth in float has been extraordinary. We are now the country's second-largest P/C company measured by premium volume and its leader, by far, in float. Here's the record. Our 2017 volume was boosted by a huge deal in which we reinsured up to $20 billion of long-tail losses that AIG had incurred. Our premium for this policy was $10.2 billion, a world's record and one we won't come close to repeating. Premium volume will therefore fall somewhat in 2018. Float will probably increase slowly for at least a few years. When we eventually experience a decline, it will be modest, at most 3% or so in any single year. Unlike bank deposits or life insurance policies containing surrender options, P/C float can't be withdrawn. This means that P/C companies can't experience massive runs in times of widespread financial stress, a characteristic of prime importance to Berkshire that we factor into our investment decisions. Charlie and I never will operate Berkshire in a manner that depends on the kindness of strangers, or even that of friends who may be facing liquidity problems of their own. During the 2008 to 2009 crisis, we liked having treasury bills, loads of treasury bills. That protected us from having to rely on funding sources such as bank loans or commercial paper. We have intentionally constructed Berkshire in a manner that will allow it to comfortably withstand economic discontinuities, including such extremes as extended market closures. The downside of float is that it comes with risk, sometimes oceans of risk. What looks predictable in insurance and can be anything but. Take the famous Lloyd's insurance market, which produced decent results for 3 centuries. In the 1980s, though, huge latent problems from a few long-tail lines of insurance surfaced at Lloyd's and, for a time, threatened to destroy its storied operation. It has, I should add, fully recovered. Berkshire's insurance managers are conservative and careful underwriters who operate in a culture that has long prioritized those qualities. That disciplined behavior has produced underwriting profits in most years, and in such instances, our cost of float was less than zero. In effect, we got paid then for holding the huge sums tallied in the earlier table. I have warned you, however, that we have been fortunate in recent years, and that the catastrophe-light period the industry was experiencing was not a new norm. Last September drove home that point, as 3 significant hurricanes hit Texas, Florida, and Puerto Rico. My guess at this time is that the insured losses arising from the hurricanes are $100 billion or so. That figure, however, could be far off the mark. The pattern with most mega catastrophes has been that initial loss estimates ran low. As well-known analyst V.J. Dowling has pointed out, the loss reserves of an insurer are similar to a self-graded exam. Ignorance, wishful thinking, or, occasionally, downright fraud can deliver inaccurate figures about an insurer's financial condition for a very long time. We currently estimate Berkshire's losses from the 3 hurricanes to be $3 billion, or about $2 billion after tax. If both that estimate and my industry estimate of $100 billion are close to accurate, our share of the industry loss was about 3%. I believe that percentage is also what we may reasonably expect to be our share of losses in future American megacats. It's worth noting that the $2 billion net cost from the 3 hurricanes reduced Berkshire's GAAP net worth by less than 1%. Elsewhere in the reinsurance industry, there were many companies that suffered losses in net worth ranging from 7% to more than 15%. The damage to them could have been far worse. Had Hurricane Irma followed a path through Florida only a bit to the east, insured losses might well have been an additional $100 billion. We believe that the annual probability of a U.S. mega catastrophe causing $400 billion or more of insured losses is about 2%. No one, of course, knows the correct probability. We do know, however, that the risk increase over time because of growth in both the number and value of structures located in catastrophe-vulnerable areas. No company comes close to Berkshire in being financially prepared for a $400 billion megacat. Our share of such a loss might be $12 billion or so, an amount far below the annual earnings we expect from our non-insurance activities. Concurrently, much indeed, perhaps most, of the P/C world would be out of business. Our unparalleled financial strength explains why other P/C insurers come to Berkshire, and only Berkshire, when they, themselves, need to purchase huge reinsurance coverages for large payments they may have to make in the far future. Prior to 2017, Berkshire had recorded 14 consecutive years of underwriting profits, which totaled $28.3 billion pre-tax. I have regularly told you that I expect Berkshire to attain an underwriting profit in a majority of years, but also to experience losses from time to time. My warning became fact in 2017, as we lost $3.2 billion pre-tax from underwriting. A large amount of additional information about our various insurance operations is included in the 10-K at the back of this report. The only point I will add here is that you have some extraordinary managers working for you at our various P.C. operations. This is a business in which there are no trade secrets, patents, or locational advantages. What counts are brains and capital. The managers of our various insurance companies supply the brains and Berkshire provides the capital. For many years, this letter has described the activities of Berkshire's many other businesses. That discussion has become both repetitious and partially duplicative of information regularly included in the 10-K that follows the letter. Consequently, this year I will give you a simple summary of our dozens of non-insurance businesses. Additional tales can be found on pages K5, K22, and pages K40, K50. Viewed as a group, and excluding investment income, our operations other than insurance delivered pre-tax income of $20 billion in 2017, an increase of $950 million over 2016. About 44% of the 2017 profit came from two subsidiaries, BNSF, our railroad, and Berkshire Hathaway Energy, of which we own 90.2%. You can read more about these businesses on pages K5, K10, and pages K40, K44. Proceeding down Berkshire's long list of subsidiaries, our next 5 non-insurance businesses, as ranked by earnings, but presented here alphabetically: Clayton Homes, International Metalworking Companies, Lubrizol, Marmon, and Precision Castparts, had aggregate pre-tax income in 2017 of $5.5 billion, little changed from the $5.4 billion these companies earned in 2016. The next 5, similarly ranked and listed, Forest River, Johns Manville, Mitek, Shaw, and TTI, earned $2.1 billion last year, up from $1.7 billion in 2016. The remaining businesses that Berkshire owns, and there are many, recorded little change in pre-tax income, which was $3.7 billion in 2017 versus $3.5 billion in 2016. Depreciation charges for all of these non-insurance operations totaled $7.6 billion. Capital expenditures were $11.5 billion. Berkshire is always looking for ways to expand its businesses and regularly incurs capital expenditures that far exceed its depreciation charge. Almost 90% of our investments are made in the United States. America's economic soil remains fertile. Amortization charges were an additional $1.3 billion. I believe that in large part this item is not a true economic cost. Partially offsetting this good news is the fact that BNSF, like all other railroads, records depreciation charges that fall well short of the sums regularly needed to keep the railroad in first-class shape. Berkshire's goal is to substantially increase the earnings of its non-insurance group. For that to happen, we will need to make one or more huge acquisitions. We certainly have the resources to do so. At year-end, Berkshire held $116 billion in cash and U.S. Treasury bills, whose average maturity was 88 days, up from $86.4 billion at year-end 2016. This extraordinary liquidity earns only a pittance and is far beyond the level Charlie and I wish Berkshire to have. Our smiles will broaden when we have redeployed Berkshire's excess funds into more productive assets. Investments. Below we list our 15 common stock investments that at year-end had the largest market value. We exclude Kraft Heinz holding 325,442,152 shares because Berkshire is part of a control group and therefore must account for this investment on the equity method. On its balance sheet, Berkshire carries its Kraft Heinz holding at a GAAP figure of $17.6 billion. The shares had a year-end market value of $25.3 billion and a cost basis of $9.8 billion. Asterisk excludes shares held by pension funds of Berkshire subsidiaries. Asterisk asterisk. This is our actual purchase price and also our tax basis. GAAP cost differs in a few cases because of write-downs that have been required under GAAP rules. Some of the stocks in the table are the responsibility of either Todd Combs or Ted Weschler, who work with me in managing Berkshire's investments. Each, independently of me, manages more than $12 billion. I usually learn about decisions they have made by looking at monthly portfolio summaries. Included in the $25 billion that the two manage is more than $8 billion of pension trust assets of certain Berkshire subsidiaries. As noted, Pension investments are not included in the preceding tabulation of Berkshire holdings. Charlie and I view the marketable common stocks that Berkshire owns as interests in businesses, not as ticker symbols to be bought or sold based on their chart patterns, the target prices of analysts, or the opinions of media pundits. Instead, we simply believe that if the businesses of the investees are successful, as we believe most will be, our investments will be successful as well. Sometimes the payoffs to us will be modest, occasionally the cash register will ring loudly, and sometimes I will make expensive mistakes. Overall and over time we should get decent results. In America, equity investors have the wind at their back. From our stock portfolio, call our holdings minority interests, in a diversified group of publicly owned businesses, Berkshire received $3.7 billion of dividends in 2017. That's the number included in our GAAP figures, as well as in the operating earnings we reference in our quarterly and annual reports. That dividend figure, however, far understates the true earnings emanating from our stock holdings. For decades, we have stated in Principle 6 of our Owner-Related Business Principles, page 19, that we expect undistributed earnings of our investees to deliver us at least equivalent earnings by way of subsequent capital gains. Our recognition of capital gains and losses will be lumpy, particularly as we conform with the new GAAP rule requiring us to constantly record unrealized gains or losses in our earnings. I feel confident, however, that the earnings retained by our investees will over time, and with our investees viewed as a group, translate into commensurate capital gains for Berkshire. The connection of value building to retained earnings that I've just described will be impossible to detect in the short term. Stocks surge and swoon, seemingly untethered to any year-to-year build-up in their underlying value. Over time, however, Ben Graham's oft-quoted maxim proves true. In the short run, the market is a voting machine. In the long run, however, it becomes a weighing machine. Berkshire, itself, provides some vivid examples of how price randomness in the short term can obscure long-term growth in value. For the last 53 years, the company has built value by reinvesting its earnings and letting compound interest work its magic. Year by year, we have moved forward. Yet Berkshire shares have suffered 4 truly major dips. Here are the gory details. This table offers the strongest argument I can muster against ever using borrowed money to own stocks. There is simply no telling how far stocks can fall in a short period. Even if your borrowings are small, and your positions aren't immediately threatened by the plunging market, your mind may well become rattled by scary headlines and breathless commentary. And an unsettled mind will not make good decisions. In the next 53 years our shares, and others, will experience declines resembling those in the table. No one can tell you when these will happen. The light can at any time go from green to red without pausing at yellow. When major declines occur, however, they offer extraordinary opportunities to those who are not handicapped by debt. That's the time to heed these lines from Kipling's If you can keep your head when all about you are losing theirs. If you can wait, and not be tired by waiting. If you can think, and not make thoughts your aim. If you can trust yourself when all men doubt you. Yours is the earth, and everything that's in it. The bet is over and has delivered an unforeseen investment lesson. Last year, at the 90% mark, I gave you a detailed report on a 10-year bet I had made on the 19th of December, 2007. The full discussion from last year's annual report is reprinted on pages 24-26. Now I have the final tally, and, in several respects, it's an eye-opener. I made the bet for 2 reasons. 1. To leverage my outlay of $318,250 into a disproportionately larger sum that, if things turned out as I expected, would be distributed in early 2018 to Girls Incorporated of Omaha. And 2. Publicize my conviction that my pick, a virtually cost-free investment in an unmanaged S&P 500 index fund, would, over time, deliver better results than those achieved by most investment professionals, however well-regarded and incentivized those helpers may be. Addressing this question is of enormous importance. American investors pay staggering sums annually to advisors, often incurring several layers of consequential costs. In the aggregate, do these investors get their money's worth? Indeed, again in the aggregate, do investors get anything for their outlays? Protégé Partners, my counterparty to the bet, picked 5 funds of funds that it expected to overperform the S&P 500. That was not a small sample. Those 5 funds of funds in turn owned interests in more than 200 hedge funds. Essentially, Protégé, an advisory firm that knew its way around Wall Street, selected 5 investment experts who, in turn, employed several hundred other investment experts, each managing his or her own hedge fund. This assemblage was an elite crew, loaded with brains, adrenaline, and confidence. The managers of the 5 funds of funds possessed a further advantage. They could and did rearrange their portfolios of hedge funds during the 10 years, investing with new stars while exiting their positions in hedge funds whose managers had lost their touch. Every actor on Protégé's side was highly incentivized. Both the fund of funds managers and the hedge fund managers they selected significantly shared in gains, even those achieved simply because the market generally moves upwards. In 100% of the 43 10-year periods since we took control of Berkshire, years with gains by the S&P 500 exceeded loss years. Those performance incentives, it should be emphasized, were frosting on a huge and tasty cake. Even if the funds lost money for their investors during the decade, their managers could grow very rich. That would occur because fixed fees averaging a staggering 2.12% of assets or so were paid every year by the fund of funds investors, with part off. These fees going to the managers at the 5 funds of funds, and the balance going to the 200-plus managers of the underlying hedge funds. Here's the final scorecard for the bet. Footnote. Under my agreement with Protégé Partners, the names of these funds of funds have never been publicly disclosed. I, however, have received their annual audits from Protégé. The 2016 figures for Funds A, Band C were revised slightly from those originally reported last year. Fund D was liquidated in 2017. Its average annual gain is calculated for the 9 years of its operation. The 5 funds of funds got off to a fast start, each beating the index fund in 2008. Then the roof fell in. In every one of the 9 years that followed, the funds of funds as a whole trailed the index fund. Let me emphasize that there was nothing aberrational about stock market behavior over the 10-year stretch. If a poll of investment experts had been asked late in 2007 for a forecast of long-term common stock returns, their guesses would have likely averaged close to the 8.5% actually delivered by the S&P 500. Making money in that environment should have been easy. Indeed, Wall Street helpers earned staggering sums. While this group prospered, however, many of their investors experienced a lost decade. Performance comes, performance goes. Fees never falter. The bet illuminated another important investment lesson. Though markets are generally rational, they occasionally do crazy things. Seizing the opportunities then offered does not require great intelligence, a degree in economics, or a familiarity with Wall Street jargon such as alpha and beta. What investors then need instead is an ability to both disregard mob fears or enthusiasms and to focus on a few simple fundamentals. A willingness to look unimaginative for a sustained period, or even to look foolish, is also essential. Originally, Protégé and I each funded our portion of the ultimate $1 million prize by purchasing $500,000 face amount of zero-coupon U.S. Treasury bonds, sometimes called strips. These bonds cost each of us $318,250, a bit less than 64 cents on the dollar, with the $500,000 payable in 10 years. As the name implies, the bonds we acquired paid no interest, but, because of the discount at which they were purchased, delivered a 4.56% annual return if held to maturity. Protégé and I originally intended to do no more than tally the annual returns and distribute $1 million to the winning charity when the bonds matured late in 2017. After our purchase, however, some very strange things took place in the bond market. By November 2012, our bonds, now with about 5 years to go before they matured, were selling for 95.7% of their face value. At that price, their annual yield to maturity was less than 1%. Or, to be precise, 88%. Given that pathetic return, our bonds had become a really dumb, investment compared to American equities. Over time, the S&P 500, which mirrors a huge cross-section of American business, appropriately weighted by market value, has earned far more than 10% annually on shareholders' equity net worth. In November 2012, as we were considering all this, the cash return from dividends on the S&P 500 was 2.1% annually, about triple the yield on our U.S. Treasury bond. These dividend payments were almost certain to grow. Beyond that, huge sums were being retained by the companies comprising the 500. These businesses would use their retained earnings to expand their operations and, frequently, to repurchase their shares as well. Either course would, over time, substantially increase earnings per share. And, as has been the case since 1776, whatever its problems of the minute, the American economy was going to move forward. Presented late in 2012 with the extraordinary valuation mismatch between bonds and equities, Protégé and I agreed to sell the bonds we had bought 5 years earlier and use the proceeds to buy 11,200 Berkshire B shares. The result? Girls Incorporated of Omaha found itself receiving $2,222,279 last month, rather than the $1 million it had originally hoped for. Berkshire, it should be emphasized, has not performed brilliantly since the 2012 substitution. But brilliance wasn't needed. After all, Berkshire's gain only had to beat that annual 88% bond bogey, hardly a Herculean achievement. The only risk in the bonds to Berkshire switch was that year in 2017 would coincide with an exceptionally weak stock market. Protégé and I felt this possibility, which always exists, was very low. Two factors dictated this conclusion: the reasonable price of Berkshire in late 2012, and the large asset buildup that was almost certain to occur at Berkshire during the 5 years that remained, before the bet would be settled. Even so, to eliminate all risk to the charities from the switch, I agreed to make up any shortfall if sales of the 11,200 Berkshire shares at year-end 2017 didn't produce at least $1 million. Investing is an activity in which consumption today is foregone in an attempt to allow greater consumption at a later date. Risk is the possibility that this objective won't be attained. By that standard, purportedly risk-free long-term bonds in 2012 were a far riskier investment than a long-term investment in common stocks. At that time, even a 1% annual rate of inflation between 2012 and 2017 would have decreased the purchasing power of the government bond that Protégé and I sold. I want to quickly acknowledge that in any upcoming day, week, or even year, stocks will be riskier, far riskier, than short-term U.S. bonds. As an investor's investment horizon lengthens, however, a diversified portfolio of U.S. equities becomes progressively less risky than bonds, assuming that the stocks are purchased at a sensible multiple of earnings relative to then prevailing interest rates. It is a terrible mistake for investors with long-term horizons, among them pension funds, college endowments, and savings-minded individuals, to measure their investment risk by their portfolio's ratio of bonds to stocks. Often, high-grade bonds in an investment portfolio increase its risk. A final lesson from our bet: stick with big, easy decisions and eschew activity. During the 10-year bet, the 200-plus hedge fund managers that were involved almost certainly made tens of thousands of buy and sell decisions. Most of those managers undoubtedly thought hard about their decisions, each of which they believed would prove advantageous. In the process of investing, they studied 10Ks, interviewed managements, read trade journals, and conferred with Wall Street analysts. Protégé and I, meanwhile, leaning neither on research, insights, nor brilliance, made only one investment decision during the 10 years. We simply decided to sell our bond investment at a price of more than 100 times earnings, 95.7 sale price, 88 yield, those being earnings that could not increase during the ensuing 5 years. We made the sale in order to move our money into a single security, Berkshire, that, in turn, owned a diversified group of solid businesses. Fueled by retained earnings, Berkshire's growth in value was unlikely to be less than 8% annually, even if we were to experience a so-so economy. After that kindergarten-like analysis, Protégé and I made the switch and relaxed, confident that, over time, 8% was certain to beat 88%. By a lot. The annual meeting. The annual meeting falls on May 5th, and will again be webcast by Yahoo, whose web address https://finance.yahoo.com/brclivestream. The webcast will go live at 8:45 a.m. Central Daylight Time. Yahoo will interview directors, managers, stockholders, and celebrities before the meeting and during the lunch break. Both the interviews and meeting will be translated simultaneously into Mandarin. Our partnership with Yahoo began in 2016, and shareholders have responded enthusiastically. Last year, real-time viewership increased 72% to about 3.1 million, and replays of short segments totaled 17.1 million. For those attending the meeting in person, the doors at the CenturyLink will open at 7 a.m. on Saturday to facilitate shopping prior to our shareholder movie, which begins at 8:30. The question and answer period will start at 9:15 and run until 3:30, with a 1-hour lunch break at noon. Finally, at 3:45 we will begin the formal shareholder meeting, which usually runs from 15 to 45 minutes. Shopping will end at 4:30. On Friday, May 4th, our Berkshire exhibitors at CenturyLink will be open from noon until 5 p.m. We added that extra shopping time in 2015, and serious shoppers love it. Last year, about 12,000 people came through the doors in the 5 hours we were open on Friday. Your venue for shopping will be the 194,300 square foot hall that adjoins the meeting, and in which products from dozens of our subsidiaries will be for sale. Your chairman discourages freebies. Say hello to the many Berkshire managers who will be captaining their exhibits. And be sure to view the terrific BNSF railroad layout that salutes all of our companies. Brooks, our running shoe company, will again have a special commemorative shoe to offer at the meeting. After you purchase a pair, wear them on Sunday at our 6th annual Berkshire 5K, an 8 a.m. race starting at the CenturyLink. Full details for participating will be included in the visitor's guide that will be sent to you with your meeting credentials. Entrants in the race will find themselves running alongside many of Berkshire's managers, directors, and associates. Charlie and I, however, will sleep in. Even with Brooks running shoes, our times would be embarrassing. Participation in the 5K grows every year. Help us set another record. A Geico booth in the shopping area will be staffed by a number of the company's top counselors from around the country. At last year's meeting, we set a record for policy sales, up 43% from 2016. So stop by for a quote. In most cases, Geico will be able to give you a shareholder discount, usually 8%. This special offer is permitted by 44 of the 51 jurisdictions in which we operate. One supplemental point. The discount is not additive if you qualify for another discount, such as that available to certain groups. Bring the details of your existing insurance and check out our price. We can save many of you real money. Spend the savings on other Berkshire products. Be sure to visit the Bookworm. This Omaha-based retailer will carry more than 40 books and DVDs, among them a couple of new titles. Berkshire shareholders are a bookseller's dream. When Poor Charlie's Almanac, yes, our Charlie, made its debut some years ago, we sold 3,500 copies at the meeting. The book weighed 4.85 pounds. Dove math. Our shareholders left the building that day, carrying about 812 tons of Charlie's wisdom. An attachment to the proxy material that is enclosed with this report explains how you can obtain that credential you will need for admission to both the meeting and other events. Keep in mind that most airlines substantially increase prices for the Berkshire weekend. If you are coming from far away, compare the cost of flying to Kansas City versus Omaha. The drive between the two cities is about 2 hours, and it may be that Kansas City can save you significant money. The savings for a couple could run to $1,000 or more. Spend that money with us. At Nebraska Furniture Mart, located on a 77-acre site on 72nd Street between Dodge and Pacific, we will again be having Berkshire Weekend discount pricing. To obtain the Berkshire discount at NFM, you must make your purchases between Tuesday, May 1st and Monday, May 7th inclusive, and must also present your meeting credential. Last year, the one-week volume for the store was a staggering $44.6 million. Bricks and mortar are alive and well at NFM. The period's special pricing will even apply to the products of several prestigious manufacturers that normally have ironclad rules against discounting, but which, in the spirit of our shareholder weekend, have made an exception for you. We appreciate their cooperation. During Berkshire Weekend, NFM will be open from 10 a.m. to 9 p.m. Monday through Saturday and 11 a.m. to 8 p.m. on Sunday. From 5:30 p.m. to 8 p.m. on Saturday, NFM is hosting a picnic to which you are all invited. NFM will again extend its shareholders' discount offerings to our Kansas City and Dallas stores. From May 1 St. through May 7th, shareholders who present meeting credentials or other evidence of their Berkshire ownership, such as brokerage statements, to those NFM stores will receive the same discounts enjoyed by those visiting the Omaha store. At Borsheim's, we will again have 2 shareholder-only events. The first will be a cocktail reception from 6 p.m. to 9 p.m. on Friday, May 4th. The second, the main gala, will be held on Sunday, May 6th from 9 a.m. to 4 p.m. On Saturday, we will remain open until 6 p.m. Remember, the more you buy, the more you save. Or so my daughter tells me when we visit the store. We will have huge crowds at Borsheim's throughout the weekend. For your convenience, therefore, shareholder prices will be available from Monday, April 30th through Saturday, May 12th. During that period, please identify yourself as a shareholder, either by presenting your meeting credential or a brokerage statement showing you own our stock. On Sunday afternoon, on the upper level above Borsheim's, we will have Bob Hammond and Sharon Osberg, two of the world's top bridge experts, available to play with our shareholders. If they suggest wagering on the game, change the subject. Ajit, Charlie, Bill Gates and I will likely drop by as well. My friend, Ariel Shing, will be in the mall as well on Sunday, taking on challengers at table tennis. I met Ariel when she was 9, and even then I was unable to score a point against her. Ariel represented the United States in the 2012 Olympics. If you don't mind embarrassing yourself, test your skills against her, beginning at 1 p.m. Bill Gates did pretty well playing Ariel last year, so he may be ready to again challenge her. My advice: bet on Ariel. I will participate on an advisory basis only. Gorat's will be open exclusively for Berkshire shareholders on Sunday, May 6th, serving from 12 p.m. until 1:00 p.m. To make a reservation at Gorat's, call 402-551-3733 on April 2nd, but not before. Show you are a sophisticated diner by ordering the T-bone with hash browns? We will have the same 3 financial journalists lead the question and answer period at the meeting, asking Charlie and me questions that shareholders have submitted to them by email. The journalists and their email addresses are Carol Loomis, the preeminent business journalist of her time, who may be emailed at loomisberk@gmail.com, Becky Quick, of CNBC, at berkshirequestions@cnbc.com, and Andrew Ross Sorkin, of the New York Times, at rsorkin@nytimes.com. From the questions submitted, each journalist will choose the 6 he or she decides are the most interesting and important to shareholders. The journalists have told me your question has the best chance of being selected if you keep it concise, avoid sending it in at the last moment, make it Berkshire-related, and include no more than 2 questions in any email you send them. In your email, let the journalist know if you would like your name mentioned if your question is asked. An accompanying set of questions will be asked by 3 analysts who follow Berkshire. This year, the insurance specialist will be Gary Ransom of Dowling & Partners. Questions that deal with our non-insurance operations will come from Jonathan Brandt of Ruane, Cunniff & Goldfarb, and Greg Warren of Morningstar. Since what we will be conducting is a shareholders meeting, our hope is that the analysts and journalists will ask questions that add to our owners' understanding and knowledge of their investment. Neither Charlie nor I will get so much as a clue about the questions headed our way. Some will be tough, for sure, and that's the way we like it. Multi-part questions aren't allowed. We want to give as many questioners as possible a shot at us. Our goal is for you to leave the meeting knowing more about Berkshire than when you came, and for you to have a good time while in Omaha. All told, we expect at least 54 questions, which will allow for 6 from each analyst and journalist, and for 18 from the audience. After the 54th, all questions come from the audience. Charlie and I have often tackled more than 60 by 3:30. The questioners from the audience will be chosen by means of 11 drawings that will take place at 8:15 a.m. on the morning of the annual meeting. Each of the 11 microphones installed in the arena and main overflow room will host, so to speak, a drawing. While I'm on the subject of our owners gaining knowledge, let me remind you that Charlie and I believe all shareholders should simultaneously have access to new information that Berkshire releases, and, if possible, should also have adequate time to digest and analyze that information before any trading takes place. That's why we try to issue financial data late on Fridays or early on Saturdays, and why our annual meeting is always held on a Saturday, a day that also eases traffic and parking problems. We do not follow the common practice of talking one-on-one with large institutional investors or analysts, treating them instead as we do all other shareholders. There is no one more important to us than the shareholder of limited means who trusts us with a substantial portion of his or her savings. As I run the company day to day, and as I write this letter, that is the shareholder whose image is in my mind. For good reason, I regularly extol the accomplishments of our operating managers. They are truly all-stars who run their businesses as if they were the only asset owned by their families. I also believe the mindset of our managers to be as shareholder-oriented as can be found in the universe of large publicly owned companies. Most of our managers have no financial need to work. The joy of hitting business home runs means as much to them as their paycheck. If managers, or directors, own Berkshire shares, and many do, it's from open market purchases they have made, or because they received shares when they sold their businesses to us. None, however, gets the upside of ownership without risking the downside. Our directors and managers stand in your shoes. We continue to have a wonderful group at headquarters. This team efficiently deals with a multitude of SEC and other regulatory requirements, files a 32,700-page federal income tax return, oversees the filing of 3,935 state tax returns, responds to countless shareholder and media inquiries, gets out the annual report, prepares for the country's largest annual meeting, coordinates the board's activities, fact-checks this letter, and the list goes on and on. They handle all of these business tasks cheerfully and with unbelievable efficiency, making my life easy and pleasant. Their efforts go beyond activities strictly related to Berkshire. Last year, for example, they dealt with the 40 universities, selected from 200 applicants, who sent students to Omaha for a Q&A with me. They all handle all kinds of requests that I receive, arrange my travel, and even get me hamburgers and French fries, smothered in Heinz ketchup, of course, for lunch. In addition, they cheerfully pitch in to help at the annual meeting in whatever way they are needed. They are proud to work for Berkshire, and I am proud of them. I've saved the best for last. Early in 2018, Berkshire's board elected Ajit Jain and Greg Abel as directors of Berkshire, and also designated each as vice chairman. Ajit is now responsible for insurance operations, and Greg oversees the rest of our businesses. Charlie and I will focus on investments and capital allocation. You and I are lucky to have Ajit and Greg working for us. Each has been with Berkshire for decades, and Berkshire's blood flows through their veins. The character of each man matches his talents. And that says it all. Come to Omaha, the cradle of capitalism, on May 5th, and meet the Berkshire Bunch. All of us look forward to your visit. Warren E. Buffett, Chairman of the Board. Berkshire's performance versus the S&P 500. Note: data are for calendar years with these exceptions. 1,965 and 1966, year ended 9/30, 1,967, 15 months ended 12/31. Starting in 1979, accounting rules required insurance companies to value the equity securities they hold at market rather than at the lower of cost or market, which was previously the requirement. In this table, Berkshire's results through 1,978 have been restated to conform to the changed rules. In all other respects, the results are calculated using the numbers originally reported. The S&P 500 numbers are pre-tax, whereas the Berkshire numbers are after-tax. If a corporation such as Berkshire were simply to have owned the S&P 500 and accrued the appropriate taxes, its results would have lagged the S&P 500 years when that index showed a positive return, but would have exceeded the S&P 500 years when the index showed a negative return. Over the years, the tax costs would have caused the aggregate lag to be substantial. Berkshire Hathaway Inc. To the shareholders of Berkshire Hathaway Incorporated. Berkshire earned $4 billion in 2018 utilizing generally accepted accounting principles, commonly called GAAP. The components of that figure are $24.8 billion in operating earnings, a $3 billion non-cash loss from an impairment of intangible assets, arising almost entirely from our equity interest in Kraft Heinz, $2.8 billion in reals capital gains from the sale of investment securities, and a $20.6 billion loss from a reduction in the amount of unrealized capital gains that existed in our investment holdings. A new GAAP rule requires us to include that last item in earnings. As I emphasized in the 2017 annual report, neither Berkshire's vice chairman, Charlie Munger, nor I believe that rule to be sensible. Rather, both of us have consistently thought that at Berkshire, this mark-to-market change would produce what I described as wild and capricious swings in our bottom line. The accuracy of that prediction can be suggested by our quarterly results during 2018. In the first and fourth quarters, we reported GAAP losses of $1.1 billion and $25.4 billion respectively. In the second and third quarters, we reported profits of $12 billion and $18.5 billion. In complete contrast to these gyrations, the many businesses that Berkshire owns delivered consistent and satisfactory operating earnings in all quarters. For the year, those earnings succeeded their 2016 high of $17.6 billion by 41%. Wide swings in our quarterly GAAP earnings will inevitably continue. That's because our huge equity portfolio, valued at nearly $173 billion at the end of 2018, will often experience one-day price fluctuations of $2 billion or more, all of which the new rule says must be dropped immediately to our bottom line. Indeed, in the fourth quarter, a period of high volatility in stock prices, we experienced several days with a profit or loss of more than $4 billion. Our advice? Focus on operating earnings, paying little attention to gains or losses of any variety. My saying that in no way diminishes the importance of our investments to Berkshire. Over time, Charlie and I expect them to deliver substantial gains, albeit with highly irregular timing. Longtime readers of our annual reports will have spotted the different way in which I open this letter. For nearly 3 decades, the initial paragraph featured the percentage change in Berkshire's per-share book value. It's now time to abandon that practice. The fact is that the annual change in Berkshire's book value, which makes its farewell appearance on page 2, is a metric that has lost the relevance it once had. 3 circumstances have made that so. First, Berkshire has gradually morphed from a company whose assets are concentrated in marketable stocks into one whose major value resides in operating businesses. Charlie and I expect that reshaping to continue in an irregular manner. Second, while our equity holdings are valued at market prices, accounting rules require our collection of operating companies to be included in book value at an amount far below their current value, mismark that has grown in recent years. Third, it is likely that, over time, Berkshire will be a significant repurchaser of its shares, transactions that will take place at prices above book value but below our estimate of intrinsic value. The math of such purchases is simple. Each transaction makes per-share intrinsic value go up, while per-share book value goes down. That combination causes the book value scorecard to become increasingly out of touch with economic reality. In future tabulations of our financial results, we expect to focus on Berkshire's market price. Markets can be extremely capricious. Just look at the 54-year history laid out on page 2. Over time, however, Berkshire's stock price will provide the best measure of business performance. Before moving on, I want to give you some good news, really good news, that is not reflected in our financial statements. It concerns the management changes we made in early 2018, when Ajit Jain was put in charge of all insurance activities and Greg Abel was given authority over all other operations. These moves were overdue. Berkshire is now far better managed than when I alone was supervising operations. Ajit and Greg have rare talents, and Berkshire blood flows through their veins. Now let's take a look at what you own. Focus on the forest. Forget the trees. Investors who evaluate Berkshire sometimes obsess on the details of our many and diverse businesses, our economic trees, so to speak. Analysis of that type can be mind-numbing, given that we own a vast array of specimens, ranging from twigs to redwoods. A few of our trees are diseased and unlikely to be around a decade from now. Many others, though, are destined to grow in size and beauty. Fortunately, it's not necessary to evaluate each tree individually to make a rough estimate of Berkshire's intrinsic business value. That's because our forest contains 5 groves of major importance, each of which can be appraised, with reasonable accuracy, in its entirety. 4 of those groves are differentiated clusters of businesses and financial assets that are easy to understand. The 5th, a huge and diverse insurance operation, delivers great value to Berkshire in a less obvious manner, one I will explain later in this letter. Before we look more closely at the first 4 groves, let me remind you of our prime goal in the deployment of your capital: to buy ably managed businesses, in whole or part, that possess favorable and durable economic characteristics. We also need to make these purchases at sensible prices. Sometimes we can buy control of companies that meet our tests. Far more often, we find the attributes we seek in publicly traded businesses, in which we normally acquire a 5% to 10% interest. Our 2-pronged approach to huge-scale capital allocation is rare in corporate America, and at times, gives us an important advantage. In recent years, the sensible course for us to follow has been clear. Many stocks have offered far more for our money than we could obtain by purchasing businesses in their entirety. That disparity led us to buy about $43 billion of marketable equities last year, while selling only $19 billion. Charlie and I believe the companies in which we invested offered excellent value, far exceeding that available in takeover transactions. Despite our recent additions to marketable equities, the most valuable grove in Berkshire's forest remains the many dozens of non-insurance businesses that Berkshire controls, usually with 100% ownership, and never with less than 80%. Those subsidiaries earned $16.8 billion last year. When we say earned, Moreover, we are describing what remains after all income taxes, interest payments, managerial compensation, whether cash or stock-based, restructuring expenses, depreciation, amortization, and home office overhead. That brand of earnings is a far cry from that frequently touted by Wall Street bankers and corporate CEOs. Too often, their presentations feature adjusted EBITDA, a measure that redefines earnings to exclude a variety of fall-to real costs. For example, management sometimes assert that their company's stock-based compensation shouldn't be counted as an expense. What else could it be? A gift from shareholders. And restructuring expenses? Well, maybe last year's exact rearrangement won't recur. But restructurings of one sort or another are common in business. Berkshire has gone down that road dozens of times, and our shareholders have always borne the costs of doing so. Abraham Lincoln once posed the question, "If you call a dog's tail a leg, how many legs does it have?" And then answered his own query, 4, because calling a tail a leg doesn't make it one. Abe would have felt lonely on Wall Street. Charlie and I do contend that our acquisition-related amortization expenses of $1.4 billion, detailed on page K84, are not a true economic cost. We add back such amortization costs to GAAP earnings when we are evaluating both private businesses and marketable stocks. In contrast, Berkshire's $8.4 billion depreciation charge understates our true economic cost. In fact, we need to spend more than this sum annually to simply remain competitive in our many operations. Beyond those maintenance capital expenditures, we spend large sums in pursuit of growth. Overall, Berkshire invested a record $14.5 billion last year in plant, equipment, and other fixed assets, with 89% of that spent in America. Berkshire's runner-up Grove by value is its collection of equities, typically involving a 5% to 10% ownership position in a very large company. As noted earlier, our equity investments were worth nearly $173 billion at year-end, an amount far above their cost. If the portfolio had been sold at its year-end valuation, federal income tax of about $14.7 billion would have been payable on the gain. In all likelihood, we will hold most of these stocks for a long time. Eventually, however, gains generate taxes at whatever rate prevails at the time of sale. Our investees paid us dividends of $3.8 billion last year, a sum that will increase in 2019. Far more important than the dividends, though, are the huge earnings that are annually retained by these companies. Consider, as an indicator, these figures that cover only our 5 largest holdings. 1. Based on current annual rate. 2. Based on 2018 earnings minus common and preferred dividends paid. GAAP, which dictates the earnings we report, does not allow us to include the retained earnings of investees in our financial accounts. But those earnings are of enormous value to us. Over the years, earnings retained by our investees, viewed as a group, have eventually delivered capital gains to Berkshire that totaled more than $1 for each dollar these companies reinvested for us. All of our major holdings enjoy excellent economics, and most use a portion of their retained earnings to purchase their shares. We very much like that. If Charlie and I think an investee's stock is underpriced, we rejoice when management employs some of its earnings to increase Berkshire's ownership percentage. Here's one example drawn from the table above. Berkshire's holdings of American Express have remained unchanged over the past 8 years. Meanwhile, our ownership increased from 12.6% to 17.9% because of free purchases made by the company. Last year, Berkshire's portion of the $6.9 billion earned by American Express was $1.2 billion, about 96% of the $1.3 billion we paid for our stake in the company. When earnings increase and shares outstanding decrease, owners, over time, usually do well. A third category of Berkshire's business ownership is a quartet of companies in which we share control with other parties. Our portion of the after-tax operating earnings of these businesses, 26.7% of Kraft Heinz, 50% of Berkadia and Electric Transmission Texas, and 38.6% of Pilot Flying J, totaled about $1.3 billion in 2018. In our fourth Grove, Berkshire held $112 billion at year-end in U.S. Treasury bills and other cash equivalents, and another $20 billion in miscellaneous fixed income instruments. We consider a portion of that stash to be untouchable, having pledged to always hold at least $20 billion in cash equivalents to guard against external calamities. We have also promised to avoid any activities that could threaten our maintaining that buffer. Berkshire will forever remain a financial fortress. In managing, I will make expensive mistakes off commission, and will also miss many opportunities, some of which should have been obvious to me. At times, our stock will tumble as investors flee from equities, but I will never risk getting caught short of cash. In the years ahead, we hope to move much of our excess liquidity into businesses that Berkshire will permanently own. The immediate prospects for that, however, are not good. Prices are sky high for businesses possessing decent long-term prospects. That disappointing reality means that 2019 will likely see us again expanding our holdings of marketable equities. We continue, nevertheless, to hope for an elephant-sized acquisition. Even at our ages of 88 and 95, I'm the young one, that prospect is what causes my heart and Charlie's to beat faster. Just writing about the possibility of a huge purchase has caused my pulse rate to soar. My expectation of more stock purchases is not a market call. Charlie and I have no idea as to how stocks will behave next week or next year. Predictions of that sort have never been a part of our activities. Our thinking, rather, is focused on calculating whether a portion of an attractive business is worth more than its market price. I believe Berkshire's intrinsic value can be approximated by summing the values of our 4 asset-laden groves and then subtracting an appropriate amount for taxes eventually payable on the sale of marketable securities. You may ask whether an allowance should not also be made for the major tax costs Berkshire would incur if we were to sell certain of our wholly owned businesses. Forget that thought. It would be foolish for us to sell any of 4 wonderful companies, even if no tax would be payable on its sale. Truly good businesses are exceptionally hard to find. Selling any you are lucky enough to own makes no sense at all. The interest cost on all of our debt has been deducted as an expense in calculating the earnings at Berkshire's non-insurance businesses. Beyond that, much of our ownership of the first 4 groves is financed by funds generated from Berkshire's 5th grove, a collection of exceptional insurance companies. We call those funds float, a source of financing that we expect to be cost-free, or maybe even better than that over time. We will explain the characteristics of float later in this letter. Finally, a point of key and lasting importance. Berkshire's value is maximized by our having assembled the 5 groves into a single entity. This arrangement allows us to seamlessly and objectively allocate major amounts of capital, eliminate enterprise risk, avoid insularity, fund assets at exceptionally low cost, occasionally take advantage of tax efficiencies, and minimize overhead. At Berkshire, the whole is greater, considerably greater, than the sum of the parts. Repurchases and reporting. Earlier, I mentioned that Berkshire will from time to time be repurchasing its own stock. Assuming that we buy at a discount to Berkshire's intrinsic value, which certainly will be our intention, repurchases will benefit both those shareholders leaving the company and those who stay. True, the upside from repurchases is very slight for those who are leaving. That's because careful buying bias will minimize any impact on Berkshire's stock price. Nevertheless, there is some benefit to sellers in having an extra buyer in the market. For continuing shareholders, the advantage is obvious. If the market prices a departing partner's interest at, say, 90 cents on the dollar, continuing shareholders reap an increase in per-share intrinsic value with every repurchase by the company. Obviously, repurchases should be price-sensitive. Blindly buying an overpriced stock is value-destructive, a fact lost on many promotional or ever-optimistic CEOs. When a company says that it contemplates repurchases, it's vital that all shareholder partners be given the information they need to make an intelligent estimate of value. Providing that information is what Charlie and I try to do in this report. We do not want a partner to sell shares back to the company because he or she has been misled or inadequately informed. Some sellers, however, may disagree with our calculation of value, and others may have found investments that they consider more attractive than Berkshire shares. Some of that second group will be right. There are unquestionably many stocks that will deliver far greater gains than ours. In addition, certain shareholders will simply decide it's time for them or their families to become net consumers rather than continuing to build capital. Charlie and I have no current interest in joining that group. Perhaps we will become big spenders in our old age. For 54 years, our managerial decisions at Berkshire have been made from the viewpoint of the shareholders who are staying, not those who are leaving. Consequently, Charlie and I have never focused on current quarter results. Berkshire, in fact, may be the only company in the Fortune 500 that does not prepare monthly earnings reports or balance sheets. I, of course, regularly view the monthly financial reports of most subsidiaries. But Charlie and I learn of Berkshire's overall earnings and financial position only on a quarterly basis. Furthermore, Berkshire has no company-wide budget, though many of our subsidiaries find one useful. Our lack of such an instrument means that the parent company has never had a quarterly number to hit. Shunning use of this bogey sends an important message to our many managers, reinforcing the culture we prize. Over the years, Charlie and I have seen all sorts of bad corporate behavior, both accounting and operational, induced by the desire of management to meet Wall Street expectations. What starts as an innocent fudge in order to not disappoint the street, say, trade loading at quarter end, turning a blind eye to rising insurance losses, or drawing down a cookie jar reserve, can become the first step toward full-fledged fraud. Playing with the numbers just this once may well be the CEO's intent. It's seldom the end result. And if it's okay for the boss to cheat a little, it's easy for subordinates to rationalize similar behavior. At Berkshire, our audience is neither analysts nor commentators. Charlie and I are working for our shareholder partners. The numbers that flow up to us will be the ones we send on to you. Non-insurance operations. From lollipops to locomotives. Let's now look further at Berkshire's most valuable grove, our collection of non-insurance businesses, keeping in mind that we do not wish to unnecessarily hand our competitors information that might be useful to them. Additional details about individual operations can be found on pages K5, K22, and pages K40, K51. Viewed as a group, these businesses earned pre-tax income in 2018 of $20.8 billion, a 24% increase over 2017. Acquisitions we made in 2018 delivered only a trivial amount of that gain. I will stick with pre-tax figures in this discussion, but our after-tax gain in 2018 from these businesses was far greater, 47%, thanks in large part to the cut in the corporate tax rate that became effective at the beginning of that year. Let's look at why the impact was so dramatic. Begin with an economic reality. Like it or not, the U.S. government owns an interest in Berkshire's earnings of a size determined by Congress. In effect, our country's Treasury Department holds a special class of our stock, call this holding the AA shares, that receives large dividends, that is, tax payments, from Berkshire. In 2017, as in many years before, the corporate tax rate was 35%, which meant that the Treasury was doing very well with its AA shares. Indeed, the Treasury's stock, which was paying nothing when we took over in 1965, had evolved into a holding that delivered billions of dollars annually to the federal government. Last year, however, 40% of the government's ownership, 14/35, was returned to Berkshire free of charge, when the corporate tax rate was reduced to 21%. Consequently, our A and B shareholders received a major boost in the earnings attributable to their shares. This happening materially increased the intrinsic value of the Berkshire shares you and I own. The same dynamic, moreover, enhanced the intrinsic value of almost all of the stocks Berkshire holds. Those are the headlines. But there are other factors to consider that tempered our gain. For example, the tax benefits garnered by our large utility operation get passed along to its customers. Meanwhile, the tax rate applicable to the substantial dividends we receive from domestic corporations is little changed at about 13%. This lower rate has long been logical because our investees have already paid tax on the earnings that they pay to us. Overall, however, the new law made our businesses and the stocks we own considerably more valuable, which suggests that we return to the performance of our non-insurance businesses. Our two towering redwoods in this grove are BNSF and Berkshire Hathaway Energy, 90.9% owned. Combined, they earned $9.3 billion before tax last year, up 6% from 2017. You can read more about these businesses on pages K5, K10, and pages K40, K45. Our next 5 non-insurance subsidiaries, as ranked by earnings, but presented here alphabetically: Clayton Homes, International Metalworking, Lubrizol, Marmon and Precision Castparts, had aggregate pre-tax income in 2018 of $6.4 billion, up from the $5.5 billion these companies earned in 2017. The next 5, similarly ranked and listed: Forest River, Johns Manville, Mytech, Shaw, and TTI, earned $2.4 billion pre-tax last year, up from $2.1 billion in 2017. The remaining non-insurance businesses that Berkshire owns, and there are many, had pre-tax income of $3.6 billion in 2018 versus $3.3 billion in 2017. Insurance, float, and the funding of Berkshire. Our property, casualty, PC, insurance business, our 5th grove, has been the engine propelling Berkshire's growth since 1967, the year we acquired National Indemnity and its sister company, National Fire and Marine, for $8.6 million. Today, National Indemnity is the largest property casualty company in the world as measured by net worth. One reason we were attracted to the P&C business was the industry's business model. P&C insurers receive premiums up front and pay claims later. In extreme cases, such as claims arising from exposure to asbestos or severe workplace accidents, payments can stretch over many decades. This collect now, pay later model leaves P&C companies holding large sums money we call float that will eventually go to others. Meanwhile, insurers get to invest this float for their own benefit. Though individual policies and claims come and go, the amount of float an insurer holds usually remains fairly stable in relation to premium volume. Consequently, as our business grows, so does our float. And how it has grown, as the following table shows, includes float arising from life, annuity and health insurance businesses. We may in time experience a decline in float. If so, the decline will be very gradual, at the outside no more than 3% in any year. The nature of our insurance contracts is such that we can never be subject to immediate or near-term demands for sums that are of significance to our cash resources. That structure is by design and is a key component in the unequaled financial strength of our insurance companies. That strength will never be compromised. If our premiums exceed the total of our expenses and eventual losses, our insurance operation registers an underwriting profit that adds to the investment income the float produces. When such a profit is earned, we enjoy use of free money, and better yet, get paid for holding it. Unfortunately, the wish of all insurers to achieve this happy result creates intense competition, so vigorous indeed that it sometimes causes the P&C industry as a whole to operate at a significant underwriting loss. That loss, in effect, is what the industry pays to hold its float. Competitive dynamics almost guarantee that the insurance industry, despite the float income all its companies enjoy, will continue its dismal record of earning subnormal returns on tangible net worth, as compared to other American businesses. Nevertheless, I like our own prospects. Berkshire's unrivaled financial strength allows us far more flexibility in investing our float than that generally available to P&C companies. The many alternatives available to us are always an advantage and occasionally offer major opportunities. When other insurers are constrained, our choices expand. Moreover, our P&C companies have an excellent underwriting record. Berkshire has now operated at an underwriting profit for 15 of the past 16 years, the exception being 2017, when our pre-tax loss was $3.2 billion. For the entire 16-year span, our pre-tax gain totaled $27 billion, of which $2 billion was recorded in 2018. That record is no accident. Disciplined risk evaluation is the daily focus of our insurance managers, who know that the benefits of float can be drowned by poor underwriting results. All insurers give that message lip service. At Berkshire, it is a religion, Old Testament style. In most cases, the funding of a business comes from two sources: debt and equity. At Berkshire, we have two additional arrows in the quiver to talk about, but let's first address the conventional components. We use debt sparingly. Many managers, it should be noted, will disagree with this policy, arguing that significant debt juices the returns for equity owners. And these more venturesome CEOs will be right most of the time. At rare and unpredictable intervals, however, credit vanishes and debt becomes financially fatal. A Russian roulette equation, usually win, occasionally die, may make financial sense for someone who gets a piece of a company's upside but does not share in its downside. But that strategy would be madness for Berkshire. Rational people don't risk what they have and need for what they don't have and don't need. Most of the debt you see on our consolidated balance sheet, see page K65, resides at our railroad and energy subsidiaries, both of them asset-heavy companies. During recessions, the cash generation of these businesses remains bountiful. The debt they use is both appropriate for their operations and not guaranteed by Berkshire. Our level of equity capital is a different story. Berkshire's $349 billion is unmatched in corporate America. By retaining all earnings for a very long time and allowing compound interest to work its magic, we have amassed funds that have enabled us to purchase and develop the valuable groves earlier described. Had we instead followed a 100% payout policy, we would still be working with the $22 million with which we began fiscal 1965. Beyond using debt and equity, Berkshire has benefited in a major way from two less common sources of corporate funding. The larger is the float I have described. So far, those funds, though they are recorded as a huge net liability on our balance sheet, have been of more utility to us than an equivalent amount of equity. That's because they have usually been accompanied by underwriting earnings. In effect, we have been paid in most years for holding and using other people's money. As I have often done before, I will emphasize that this happy outcome is far from a sure thing. Mistakes in assessing insurance risks can be huge and can take many years to surface. Think asbestos. A major catastrophe that will dwarf hurricanes Katrina and Michael will occur, perhaps tomorrow, perhaps many decades from now. The big one may come from a traditional source, such as a hurricane or earthquake, or it may be a total surprise involving, say, a cyber attack having disastrous consequences beyond anything insurers now contemplate. When such a mega catastrophe strikes, we will get our share of the losses and they will be big, very big. Unlike many other insurers, however, we will be looking to add business the next day. The final funding source, which again Berkshire possesses to an unusual degree, is deferred income taxes. These are liabilities that we will eventually pay, but that are meanwhile interest-free. As I indicated earlier, about $14.7 billion of our $5 billion of deferred taxes arises from the unrealized gains in our equity holdings. These liabilities are accrued in our financial statements at the current 21% corporate tax rate, but will be paid at the rates prevailing when our investments are sold. Between now and then, we in effect have an interest-free loan that allows us to have more money working for us in equities than would otherwise be the case. A further $28.3 billion of deferred tax results from our being able to accelerate the depreciation of assets such as plant and equipment in calculating the tax we must currently pay. The front-ended savings in taxes that we record gradually reverse in future years. We regularly purchase additional assets, however. As long as the present tax law prevails, this source of funding should trend upward. Over time, Berkshire's funding base, that's the right-hand side of our balance sheet, should grow, primarily through the earnings we retain. Our job is to put the money retained to good use on the left-hand side by adding attractive assets. Geico and Tony Nicely. That title says it all. The company and the man are inseparable. Tony joined Geico in 1961 at the age of 18. I met him in the mid-1970s. At that time, Geico, after a 4-decade record of both rapid growth and outstanding underwriting results, suddenly found itself near bankruptcy. A recently installed management had grossly underestimated Geico's loss costs and consequently underpriced its product. It would take many months until those loss-generating policies on Geico's books, there were no less than 2-3 million of them, would expire and could then be repriced. The company's net worth in the meantime was rapidly approaching zero. In 1976, Jack Byrne was brought in as CEO to rescue Geico. Soon after his arrival, I met him, concluded that he was the perfect man for the job, and began to aggressively buy Geico shares. Within a few months, Berkshire bought about 1/3 of the company, a portion that later grew to roughly 1/2, without our spending a dime. That stunning accretion occurred because Geico, after recovering its health, consistently repurchased its shares. All told, this half-interest in Geico cost Berkshire $47 million, about what you might pay today for a trophy apartment in New York. Let's now fast-forward 17 years to 1993, when Tony Nicely was promoted to CEO. At that point, Geico's reputation and profitability had been restored, but not its growth. Indeed, at year-end 1992 the company had only 1.9 million auto policies on its books, far less than its pre-crisis high. In sales volume among U.S. auto insurers, Geico then ranked an undistinguished 7th. Late in 1995, after Tony had re-energized Geico, Berkshire made an offer to buy the remaining 50% of the company for $2.3 billion, about 50 times what we had paid for the first half. And people say I never pay up. Our offer was successful, and brought Berkshire a wonderful, but underdeveloped, company and an equally wonderful CEO, who would move Geico forward beyond my dreams. Geico is now America's number 2 auto insurer, with sales 200% greater than it recorded in 1995. Underwriting profits have totaled $15.5 billion pre-tax since our purchase, and float available for investment has grown from $2.5 billion to $22.1 billion. By my estimate, Tony's management of Geico has increased Berkshire's intrinsic value by more than $50 billion. On top of that, he is a model for everything a manager should be, helping his 40,000 associates to identify and polish abilities they didn't realize they possessed. Last year, Tony decided to retire as CEO, and on June 30th he turned that position over to Bill Roberts, his longtime partner. I've known and watched Bill operate for several decades, and once again Tony made the right move. Tony remains chairman, and will be helpful to Geico for the rest of his life. He's incapable of doing less. All Berkshire shareholders owe Tony their thanks. I head the list. Investments. Below we list our 15 common stock investments that at year-end had the largest market value. We exclude our Kraft Heinz holding, 325,442,152 shares, because Berkshire is part of a control group and therefore must account for this investment on the equity method. On its balance sheet, Berkshire carries its Kraft Heinz holding at a GAAP figure of $13.8 billion, an amount reduced by our share of the large write-off of intangible assets taken by Kraft Heinz in 2018. At year-end, our Kraft Heinz holding had a market value of $14 billion and a cost basis of $9.8 billion. Excludes shares held by pension funds of Berkshire subsidiaries. ***. This is our actual purchase price and also our tax basis. Charlie and I do not view the $172.8 billion detailed above as a collection of ticker symbols, a financial dalliance to be terminated because of downgrades by the street, expected Federal Reserve actions, possible political developments, forecasts by economists, or whatever else might be the subject du jour. What we see in our holdings, rather, is an assembly of companies that we partly own, and that, on a weighted basis, are earning about 20% on the net tangible equity capital required to run their businesses. These companies, also, earn their profits without employing excessive levels of debt. Returns of that order by large, established and understandable businesses are remarkable under any circumstances. They are truly mind-blowing when compared against the return that many investors have accepted on bonds over the last decade, 3% or less on 30-year U.S. Treasury bonds, for example. On occasion, a ridiculously high purchase price for a given stock will cause a splendid business to become a poor investment, if not permanently, at least for a painfully long period. Over time, however, investment performance converges with business performance. And, as I will next spell out, the record of American business has been extraordinary. The American Tailwind. On March 11th, it will be 77 years since I first invested in an American business. The year was 1942, I was 11, and I went all in, investing $114.75 I had begun accumulating at age 6. What I bought was 3 shares of City Service preferred stock. I had become a capitalist, and it felt good. Let's now travel back through the 2 77-year periods that preceded my purchase. That leaves us starting in 1788, a year prior to George Washington's installation as our first president. Could anyone then have imagined what their new country would accomplish in only 3 77-year lifetimes? During the 2 77-year periods prior to 1942, the United States had grown from 4 million people, about 1/2% of the world's population, into the most powerful country on earth. In that spring of 1942, though, it faced a crisis. The U.S. and its allies were suffering heavy losses in a war that we had entered only 3 months earlier. Bad news arrived daily. Despite the alarming headlines, almost all Americans believed on that March 11th that the war would be won. Nor was their optimism limited to that victory. Leaving aside congenital pessimists, Americans believed that their children and generations beyond would live far better lives than they themselves had led. The nation's citizens understood, of course, that the road ahead would not be a smooth ride. It never had been. Early in its history, our country was tested by a civil war that killed 4% of all American males and led President Lincoln to openly ponder whether a nation so conceived and so dedicated could long endure. In the 1930 seconds, America suffered through the Great Depression, a punishing period of massive unemployment. Nevertheless, in 1942, when I made my purchase, the nation expected post-war growth, a belief that proved to be well-founded. In fact, the nation's achievements can best be described as breathtaking. Let's put numbers to that claim. If my $114.75 had been invested in a no-fee S&P 500 index fund, and all dividends had been reinvested, my stake would have grown to be worth pre-taxes $606,811 on the 31st of January 2019, the latest data available, before the printing of this letter. That is a gain of 5,288 for one. Meanwhile, a $1 million investment by a tax-free institution of that time, say, a pension fund or college endowment, would have grown to about $5. 3 billion. Let me add one additional calculation that I believe will shock you. If that hypothetical institution had paid only 1% of assets annually to various helpers, such as investment managers and consultants, its gain would have been cut in half to $2.65 billion. That's what happens over 77 years, when the 11.8% annual return actually achieved by the S&P 500 is recalculated at a 10.8% rate. Those who regularly preach doom because of government budget deficits, as I regularly did myself for many years, might note that our country's national debt has increased roughly 400-fold during the last of my 77-year periods. That's 0%. Suppose you had foreseen this increase and panicked at the prospect of runaway deficits and a worthless currency. To protect yourself, you might have eschewed stocks and opted instead to buy 314 ounces of gold with your $114.75. And what would that supposed protection have delivered? You would now have an asset worth about $4,200, less than 1% of what would have been realized from a simple unmanaged investment in American business. The magical metal was no match for the American metal. Our country's almost unbelievable prosperity has been gained in a bipartisan manner. Since 1942, we have had 7 Republican presidents and 7 Democrats. In the years they served, the country contended at various times with a long period of viral inflation, a 21% prime rate, several controversial and costly wars, the resignation of a president, a pervasive collapse in home values, a paralyzing financial panic, and a host of other problems. All engendered scary headlines. All are now history. Christopher Wren, architect of St. Paul's Cathedral, lies buried within that London church. Near his tomb are posted these words of description, translated from Latin. If you would seek my monument, look around you. Those skeptical of America's economic playbook should heed his message. In 1788, to go back to our starting point, there really wasn't much here except for a small band of ambitious people and an embryonic governing framework aimed at turning their dreams into reality. Today, the Federal Reserve estimates our household wealth at $108 trillion, an amount almost impossible to comprehend. Remember, earlier in this letter, how I described retained earnings as having been the key to Berkshire's prosperity. So it has been with America. In the nation's accounting, the comparable item is labeled savings. And save we have. If our forefathers had instead consumed all they produced, there would have been no investment, not productivity gains, and no leap in living standards. Charlie and I happily acknowledge that much of Berkshire's success has simply been a product of what I think should be called the American tailwind. It is beyond arrogance for American businesses or individuals to boast that they have done it alone. The tidy rows of simple white crosses at Normandy should shame those who make such claims. There are also many other countries around the world that have bright futures. About that, we should rejoice. Americans will be both more prosperous and safer if all nations thrive. At Berkshire, we hope to invest significant sums across borders. Over the next 77 years, however, the major source of our gains will almost certainly be provided by the American tailwind. We are lucky, gloriously lucky, to have that force at our back. The annual meeting. Berkshire's 2019 annual meeting will take place on Saturday, May 4th. If you are thinking about attending, and Charlie and I hope you come, check out the details on pages A2, A3. They describe the same schedule we followed for some years. If you can't join us in Omaha, attend via Yahoo's webcast. Andy Sowa and his Yahoo associates do an outstanding job, both in covering the entire meeting and interviewing many Berkshire managers, celebrities, finance experts, and shareholders from the US and abroad. The world's knowledge of what goes on in Omaha the first Saturday of every May has grown dramatically since Yahoo came on board. Its coverage begins at 8:45 a.m. CDT and provides Mandarin translation. For 54 years, Charlie and I have loved our jobs. Daily, we do what we find interesting, working with people we like and trust. And now our new management structure has made our lives even more enjoyable. With the whole ensemble, that is, with Ajit and Greg running operations, a great collection of businesses, a Niagara of cash generation, a cadre of talented managers and a rock-solid culture, your company is in good shape for whatever the future brings. Warren E. Buffett, Chairman of the Board. Berkshire's performance versus the S&P 500. Note: data are for calendar years with these exceptions. 1965 and 1966, year ended 9/30, 1967, 15 months ended 12/31. Berkshire Hathaway Inc. To the shareholders of Berkshire Hathaway Incorporated, Berkshire earned $81.4 billion in 2019 according to generally accepted accounting principles, common called GAAP. The components of that figure are $24 billion of operating earnings, $3.7 billion of realized capital gains, and a $53.7 billion gain from an increase in the amount of net unrealized capital gains that exist in the stocks we hold. Each of those components of earnings is stated on an after-tax basis. That $53.7 billion gain requires comment. It resulted from a new GAAP rule, imposed in 2018, that requires a company holding equity securities to include in earnings the net change in the unrealized gains and losses of those securities. As we stated in last year's letter, neither Charlie Munger, my partner in managing Berkshire, nor I agree with that rule. The adoption of the rule by the accounting profession, in fact, was a monumental shift in its own thinking. Before 2018, GAAP insisted, with an exception for companies whose business was to trade securities, that unrealized gains within a portfolio of stocks were never to be included in earnings and unrealized losses were to be included only if they were deemed other than temporary. Now, Berkshire must enshrine in each quarter's bottom line, a key item of news for many investors, analysts and commentators, every up and down movement of the stocks it owns, however capricious those fluctuations may be. Berkshire's 2018 and 2019 years glaringly illustrate the argument we have with the new rule. In 2018, a down year for the stock market, our net unrealized gains decreased by $20.6 billion, and we therefore reported GAAP earnings of only $4 billion. In 2019, rising stock prices increased net unrealized gains by the aforementioned $53.7 billion, pushing GAAP earnings to the $81.4 billion reported at the beginning of this letter. Those market gyrations to a crazy 900% increase in GAAP earnings. Meanwhile, in what we might call the real world, as opposed to accounting land, Berkshire's equity holdings averaged about $200 billion during the 2 years. And the intrinsic value of the stocks we own grew steadily and substantially throughout the period. Charlie and I urge you to focus on operating earnings, which were little changed in 2019, and to ignore both quarterly and annual gains or losses from investments, whether these are realized, unrealized. Our advising that in no way diminishes the importance of these investments to Berkshire. Over time, Charlie and I expect our equity holdings, as a group, to deliver major gains, albeit in an unpredictable and highly irregular manner. To see why we are optimistic, move on to the next discussion. The power of retained earnings. In 1924, Edgar Lawrence Smith, an obscure economist and financial advisor, wrote Common Stocks as Long-Term Investments, a slim book that changed the investment world. Indeed, writing the book changed Smith himself, forcing him to reassess his own investment beliefs. Going in, he planned to argue that stocks would perform better than bonds during inflationary periods, and that bonds would deliver superior returns during deflationary times. That seemed sensible enough. But Smith was in for a shock. His book began, therefore, with a confession. These studies are the record of a failure, the failure of facts to sustain a preconceived theory. Luckily for investors, that failure led Smith to think more deeply about how stocks should be evaluated. For the crux of Smith's insight, I will quote an early reviewer of his book, none other than John Maynard Keynes. I have kept until last what is perhaps Mr. Smith's most important, and is certainly his most novel, point. Well-managed industrial companies do not, as a rule, distribute to the shareholders the whole of their earned profits. In good years, if not in all years, they retain a part of their profits and put them back into the business. Thus, there is an element of compound interest, Keynes's italics, operating in favor of a sound industrial investment. Over a period of years, the real value of the property of a sound industrial is increasing at compound interest, quite apart from the dividends paid out to the shareholders. And with that sprinkling of holy water, Smith was no longer obscure. It's difficult to understand why retained earnings were unappreciated by investors before Smith's book was published. After all, it was no secret that mind-boggling wealth had earlier been amassed by such titans as Carnegie, Rockefeller, and Ford, all of whom had retained a huge portion of their business earnings to fund growth and produce ever greater profits. Throughout America, also, there had long been small-time capitalists who became rich following the same playbook. Nevertheless, when business ownership was sliced into small pieces, stocks, buyers in the pre-Smith years usually thought of their shares as a short-term gamble on market movements. Even at their best, stocks were considered speculations. Gentlemen preferred bonds. Though investors were slow to wise up, the math of retaining and reinvesting earnings is now well understood. Today, school children learn what Keynes termed novel, combining savings with compound interest works wonders. At Berkshire, Charlie and I have long focused on using retained earnings advantageously. Sometimes this job has been easy, at other times, more than difficult, particularly when we began working with huge and ever-growing sums of money. In our deployment of the funds we retain, we first seek to invest in the many and diverse businesses we already own. During the past decade, Berkshire's depreciation charges have aggregated $65 billion, whereas the company's internal investments in property, plant, and equipment have totaled $121 billion. Reinvestment in productive operational assets will forever remain our top priority. In addition, we constantly seek to buy new businesses that meet three criteria. First, they must earn good returns on the net tangible capital required in their operation. Second, they must be run by able and honest managers. Finally, they must be available at a sensible price. When we spot such businesses, our preference would be to buy 100% of them. But the opportunities to make major acquisitions possessing our required attributes are rare. Far more often, a fickle stock market serves up opportunities for us to buy large but non-controlling positions in publicly traded companies that meet our standards. Whichever way we go, controlled companies or only a major stake by way of the stock market, Berkshire's financial results from the commitment will in large part be determined by the future earnings of the business we have purchased. Nonetheless, there is between the two investment approaches a hugely important accounting difference, essential for you to understand. In our controlled companies, defined as those in which Berkshire owns more than 50% of the shares, the earnings of each business flow directly into the operating earnings that we report to you. What you see is what you get. In the non-controlled companies, in which we own marketable stocks, only the dividends that Berkshire receives are recorded in the operating earnings we report. The retained earnings? They're working hard and creating much added value, but not in a way that deposits those gains directly into Berkshire's reported earnings. At almost all major companies other than Berkshire, investors would not find what we'll call this non-recognition of earnings important. For us, however, it is a standout omission, of a magnitude that we lay out for you below. Here, we list our 10 largest stock market holdings of businesses. The list distinguishes between their earnings that are reported to you under GAAP accounting. These are the dividends Berkshire receives from those 10 investees, and our share, so to speak, of the earnings the investees retain and put to work. Normally, those companies use retained earnings to expand their business and increase its efficiency. Or sometimes they use those funds to repurchase significant portions of their own stock, an act that enlarges Berkshire's share of the company's future earnings. 1. Based on current annual rate. 2. Based on 2019 earnings minus common and preferred dividends paid. Obviously, the realized gains we will eventually record from partially owning each of these companies will not neatly correspond to our share of their retained earnings. Sometimes, alas, retentions produce nothing. But both logic and our past experience indicate that from the group we will realize capital gains at least equal to, and probably better than, the earnings of ours that they retained. When we sell shares and realize gains, we will pay income tax on the gain at whatever rate then prevails. Currently, the federal rate is 21%. It is certain that Berkshire's rewards from these 10 companies, as well as those from our many other equity holdings, will manifest themselves in a highly irregular manner. Periodically, there will be losses, sometimes company-specific, sometimes linked to stock market swoons. At other times, last year was one of those, our gain will be outsized. Overall, the retained earnings of our investees are certain to be of major importance in the growth of Berkshire's value. Mr. Smith got it right. Non-insurance operations. Tom Murphy, a valued director of Berkshire and an all-time great among business managers, long ago gave me some important advice about acquisitions. To achieve a reputation as a good manager, just be sure you buy good businesses. Over the years, Berkshire has acquired many dozens of companies, all of which I initially regarded as good businesses. Some, however, proved disappointing. More than a few were outright disasters. A reasonable number, on the other hand, have exceeded my hopes. In reviewing my uneven record, I've concluded that acquisitions are similar to marriage. They start, of course, with a joyful wedding, but then reality tends to diverge from prenuptial expectations. Sometimes, wonderfully, the new union delivers bliss beyond either party's hopes. In other cases, disillusionment is swift. Applying those imagesto corporate acquisitions, I'd have to say it is usually the buyer who encounters unpleasant surprises. It's easy to get dreamy-eyed during corporate courtships. Pursuing that analogy, I would say that our marital record remains largely acceptable, with all parties happy with the decisions they made long ago. Some of our tie-ups have been positively idyllic. A meaningful number, however, have caused me all too quickly to wonder what I was thinking when I proposed. Fortunately, the fallout from many of my errors has been reduced by a characteristic shared by most businesses that disappoint. As the years pass, the poor business tends to stagnate, thereupon entering a state in which its operations require an ever smaller percentage of Berkshire's capital. Meanwhile, our good businesses often tend to grow and find opportunities for investing additional capital at attractive rates. Because of these contrasting trajectories, the assets employed at Berkshire's winners gradually become an expanding portion of our total capital. As an extreme example of those financial movements, witness Berkshire's original textile business. When we acquired control of the company in early 1965, this beleaguered operation required nearly all of Berkshire's capital. For some time, therefore, Berkshire's non-earning textile assets were a huge drag on our overall returns. Eventually, though, we acquired a spread of good businesses, a shift that by the early 1980s caused the dwindling textile operation to employ only a tiny portion of our capital. Today, we have most of your money deployed in controlled businesses that achieve good to excellent returns on the net tangible assets each requires for its operations. Our insurance business has been the superstar. That operation has special characteristics that give it a unique metric for calibrating success, one unfamiliar to many investors. We will save that discussion for the next section. In the paragraphs that follow, we group our wide array of non-insurance businesses by size of earnings, after interest, depreciation, taxes, non-cash compensation, restructuring charges, all of those pesky but very real costs that CEOs in Wall Street sometimes urge investors to ignore. Additional information about these operations can be found on pages K6, K21, and pages K40, K52. Our BNSF Railroad and Berkshire Hathaway Energy, BHE, the two lead dogs of Berkshire's non-insurance group, earned a combined $8.3 billion in 2019, including only our 91% share of BHE, an increase of 6% from 2018. Our next 5 non-insurance subsidiaries, as ranked by earnings, but presented here alphabetically, Clayton Homes, International Metalworking, Lubrizol, Marmon and Precision Castparts, had aggregate earnings in 2019 of $4.8 billion. Little changed from what these companies earned in 2018. The next 5, similarly ranked and listed, Berkshire Hathaway Automotive, Johns Manville, NetJets, Shawan TTI, earned $1.9 billion last year, up from the $1.7 billion earned by this tier in 2018. The remaining non-insurance businesses that Berkshire owns, and there are many, had aggregate earnings of $2.7 billion in 2019, down from $2.8 billion in 2018. Our total net income in 2019 from the non-insurance businesses we control amounted to $17.7 billion, an increase of 3% from the $17.2 billion this group earned in 2018. Acquisitions and dispositions had almost no net effect in these results. I must add one final item that underscores the wide scope of Berkshire's operations. Since 2011, we have owned Lubrizol, an Ohio-based company that produces and markets oil additives throughout the world. On September 26, 2019, a fire originating at a small next-door operation spread to a large French plant owned by Lubrizol. The result was significant property damage and a major disruption in Lubrizol's business. Even so, both the company's property loss and business interruption loss will be mitigated by substantial insurance recoveries that Lubrizol will receive. But, As the late Paul Harvey was given to saying in his famed radio broadcasts, here's the rest of the story. One of the largest insurers of Lubrizol was a company owned by, Berkshire. In Matthew 6:3, the Bible instructs us to, "Let not the left hand know what the right hand doeth." Your chairman has clearly behaved as ordered. Property, casualty insurance. Our property, casualty, PC, insurance business has been the engine propelling Berkshire's growth since 1967, the year we acquired National Indemnity and its sister company, National Fire and Marine, for $8.6 million. Today, National Indemnity is the largest PC company in the world as measured by net worth. Insurance is a business of promises, and Berkshire's ability to honor its commitments is unmatched. One reason we were attracted to the PC business was the industry's business model. PC insurers receive premiums up front and pay claims later. In extreme cases, such as claims arising from exposure to asbestos or severe workplace accidents, payments can stretch over many decades. This collect now, pay later model leaves PC companies holding large sums, money we call float, that will eventually go to others. Meanwhile, insurers get to invest this float for their own benefit. Though individual policies and claims come and go, the amount of float an insurer holds usually remains fairly stable in relation to premium volume. Consequently, as our business grows, so does our float. And how it has grown, as the following table shows. We may in time experience a decline in float. If so, the decline will be very gradual, at the outside no more than 3% in any year. The nature of our insurance contracts is such that we can never be subject to immediate or near-term demands for sums that are of significance to our cash resources. That structure is by design and is a key component in the unequaled financial strength of our insurance companies. That strength will never be compromised. If our premiums exceed the total of our expenses and eventual losses, our insurance operation registers an underwriting profit that adds to the investment income the float produces. When such a profit is earned, we enjoy use of free money, and, better yet, get paid for holding it. For the PC industry as a whole, the financial value of float is now far less than it was for many years. That's because the standard investment strategy for almost all PC companies is heavily, and properly, skewed toward high-grade bonds. Changes in interest rates therefore matter enormously to these companies, and during the last decade the bond market has offered pathetically low rates. Consequently, insurers suffered, as year by year they were forced, by maturities or issuer call provisions, to recycle their old investment portfolios into new holdings providing much lower yields. Where once these insurers could safely earn 5 cents or 6 cents on each dollar of float, they now take in only 2 cents or 3 cents, or even less if their operations are concentrated in countries mired in the never-never land of negative rates. Some insurers may try to mitigate their loss of revenue by buying lower-quality bonds or non-liquid alternative investments promising higher yields. But those are dangerous games and activities that most institutions are ill-equipped to play. Berkshire's situation is more favorable than that of insurers in general. Most important, our unrivaled mountain of capital, abundance of cash, and a huge and diverse stream of non-insurance earnings allow us far more investment flexibility than is generally available to other companies in the industry. The many choices open to us are always advantageous, and sometimes have presented us with major opportunities. Our PC companies have meanwhile had an excellent underwriting record. Berkshire has now operated at an underwriting profit for 16 of the last 17 years, the exception being 2017, when our pre-tax loss was a whopping $3.2 billion. For the entire 17-year span, our pre-tax gain totaled $27.5 billion, of which $400 million was recorded in 2019. That record is no accident. Disciplined risk evaluation is the daily focus of our insurance managers, who know that the rewards of float can be drowned by poor underwriting results. All insurers give that message lip service. At Berkshire, it is a religion, Old Testament style. As I have repeatedly done in the past, I will emphasize now that happy outcomes in insurance are far from sure thing. We will most certainly not have an underwriting profit in 16 of the next 17 years. Danger always lurks. Mistakes in assessing insurance risks can be huge and can take many years, even decades, to surface and ripen. Think asbestos. A major catastrophe that will dwarf hurricanes Katrina and Michael will occur. Perhaps tomorrow, perhaps many decades from now. The big one may come from a traditional source, such as wind or earthquake, Or it may be a total surprise involving, say, a cyber attack having disastrous consequences beyond anything insurers now contemplate. When such a mega catastrophe strikes, Berkshire will get its share of the losses, and they will be big. Very big. Unlike many other insurers, however, handling the loss will not come close to straining our resources, and we will be eager to add to our business the next day. Close your eyes for a moment and try to envision a locale that might spawn a dynamic PC insurer. New York? London? Silicon Valley? How about Wilkes-Barre? Late in 2012, Achi Jain, the invaluable manager of our insurance operations, called to tell me that he was buying a tiny company, Gord Insurance Group, in that small Pennsylvania city for $221 million, roughly its net worth at the time. He added that Cy Fogel, Gord's CEO, was going to be a star at Berkshire. Both Gord and Cy were new names to me. Bingo and bingo. In 2019, Gord had premium volume of $1.9 billion, up 379% since 2012, and also delivered a satisfactory underwriting profit. Since joining Berkshire, Cy has led the company into both new products and new regions of the country, and has increased Gord's float by 265%. In 1967, Omaha seemed an unlikely launching pad for a PC giant. Wilkes-Barre may well deliver a similar surprise. Berkshire Hathaway Energy. Berkshire Hathaway Energy is now celebrating its 20th year under our ownership. That anniversary suggests that we should be catching up with the company's accomplishments. We'll start with the topic of electricity rates. When Berkshire entered the utility business in 2000, purchasing 76% of BHE, the company's residential customers in Iowa paid an average of 8 cents per kilowatt-hour QH. Prices for residential customers have since risen less than 1% a year, and we have promised that there will be no base rate price increases through 2028. In contrast, here's what is happening at the other large investor-owned Iowa utility. Last year, the rates it charged its residential customers were 61% higher than BHE's. Recently, that utility received a rate increase that will widen the gap to 70%. The extraordinary differential between our rates and theirs is largely the result of our huge accomplishments in converting wind into electricity. In 2021, we expect BHE's operation to generate about 25.2 million megawatt-hours of electricity, in Iowa from wind turbines that it both owns and operates. That output will totally cover the annual needs of its Iowa customers, which run to about 24.6 million MWh. In other words, our utility will have attained wind self-sufficiency in the state of Iowa. In still another contrast, that other Iowa utility generates less than 10% of its power from wind. Furthermore, we know of no other investor-owned utility, wherever located, that by 2021 will have achieved a position of wind self-sufficiency. In 2000, BHE was serving an agricultural-based economy. Today, 3 of its 5 largest customers are high-tech giants. I believe their decisions to site plants in Iowa were in part based upon BHE's ability to deliver renewable, low-cost energy. Of course, wind is intermittent, and our blades in Iowa turn only part of the time. In certain periods, when the air is still, we look to our non-wind generating capacity to secure the electricity we need. At opposite times, we sell the excess power that wind provides us to other utilities, serving them through what's called the grid. The power we sell them supplants their need for a carbon resource, coal, say, or natural gas. Berkshire Hathaway now owns 91% of BHE in partnership with Walter Scott, Jr. and Greg Abel. BHE has never paid Berkshire Hathaway a dividend since our purchase, and has, as the years have passed, retained $28 billion of earnings. That pattern is an outlier in the world of utilities, whose companies customarily pay big dividends, sometimes reaching or even exceeding 80% of earnings. Our view: the more we can invest, the more we like it. Today, BHE has the operating talent and experience to manage truly huge utility projects, requiring investments of $100 billion or more, that could support infrastructure benefiting our country, our communities, and our shareholders. We stand ready, willing and able to take on such opportunities. Investments. Below we list our 15 common stock investments that at year-end had the largest market value. We exclude our Kraft Heinz holding, 325,442,152 shares, because Berkshire is part of a control group and therefore must account for this investment on the equity method. On its balance sheet, Berkshire carries the Kraft Heinz holding at a GAAP figure of $13. $8 billion, an amount that represents Berkshire's share of the audited net worth of Kraft Heinz at the 31st of December 2019. Please note, though, that the market value of our shares on that date was only $10. $5 billion. Asterisk excludes shares held by pension funds of Berkshire subsidiaries. Asterisk. This is our actual purchase price, and also our tax basis. Includes $10 billion investment in Occidental Petroleum Corporation, consisting of preferred stock and warrants to buy common stock. Charlie and I do not view the $248 billion detailed above as a collection of stock market wagers. Dalian Sesto be terminated because of downgrades by the street, an earnings miss, expected, Federal Reserve actions, possible political developments, forecasts by economists, or whatever else might be the subject du jour. What we see in our holdings, rather, is an assembly of companies that we partly own, and that, on a weighted basis, are earning more than 20% on the net tangible equity capital required to run their businesses. These companies also earn their profits without employing excessive levels of debt. Returns of that order by large, established and understandable businesses are remarkable under any circumstances. They are truly mind-blowing when compared to the returns that many investors have accepted on bonds over the last decade. 2.5% or even less on 30-year U.S. Treasury bonds, for example. Forecasting interest rates has never been our game, and Charlie and I have no idea what rates will average over the next year, or 10 or 30 years. Our perhaps jaundiced view is that the pundits who opine on these subjects reveal, by that very behavior, far more about themselves than they reveal about the future. What we can say is that if something close to current rates should prevail over the coming decades, and if corporate tax rates also remain near the low-level businesses now enjoy, it is almost certain that equities will over time perform far better than long-term fixed-rate debt instruments. That rosy prediction comes with a warning: anything can happen to stock prices tomorrow. Occasionally, there will be major drops in the market, perhaps of 50% magnitude or even greater. But the combination of the American tailwind, about which I wrote last year, and the compounding wonders described by Mr. Smith will make equities the much better long-term choice for the individual who does not use borrowed money and who can control his or her emotions. Others, beware the road ahead. 3 decades ago, my Midwestern friend, Joe Rosenfield, then in his 82nd, received an irritating letter from his local newspaper. In blunt words, the paper asked for biographical data it planned to use in Joe's obituary. Joe didn't respond, so a month later he got a second letter from the paper, this one labeled urgent. Charlie and I long ago entered the urgent zone. That's not exactly great news for us, but Berkshire holders need not worry. Your company is 100% prepared for our departure. The two of us base our optimism upon 5 factors. First, Berkshire's assets are deployed in an extraordinary variety of wholly or partly owned businesses that, averaged out, earn attractive returns on the capital they use. Second, Berkshire's positioning of its controlled businesses within a single entity endows it with some important and enduring economic advantages. Third, Berkshire's financial affairs will unfailingly be managed in a manner allowing the company to withstand external shocks of an extreme nature. Fourth, we possess skilled and devoted top managers for whom running Berkshire is far more than simply having a high-paying and/or prestigious job. Finally, Berkshire's directors, your guardians, are constantly focused on both the welfare of owners and the nurturing of a culture that is rare among giant corporations. The value of this culture is explored in Margin of Trust, a new book by Larry Cunningham and Stephanie Cuba that will be available at our annual meeting. Charlie and I have very pragmatic reasons for wanting to assure Berkshire's prosperity in the years following our exit. The Mungers have Berkshire holdings that dwarf any of the family's other investments, and I have a full 99% of my net worth lodged in Berkshire stock. I have never sold any shares and have no plans to do so. My only disposal of Berkshire shares, aside from charitable donations and minor personal gifts, took place in 1980, when I, along with other Berkshire stockholders who elected to participate, exchanged some of our Berkshire shares for the shares of an Illinois bank that Berkshire had purchased in 1969, and that, in 1980, needed to be offloaded because of changes in the bank holding company law. Today, my will specifically directs its executors, as well as the trustees who will succeed them in administering my estate after the will is closed, not to sell any Berkshire shares. My will also absolves both the executors and the trustees from liability for maintaining what obviously will be an extreme concentration of assets. The will goes on to instruct the executors, and in time the trustees, to each year convert a portion of my A shares into B shares, and then distribute the Bs to various foundations. Those foundations will be required to deploy their grants promptly. In all, I estimate that it will take 12 to 15 years for the entirety of the Berkshire shares I hold at my death to move into the market. Absent my will's directive that all my Berkshire shares should be held until their scheduled distribution dates, the safe course for both my executors and trustees would be to sell the Berkshire shares under their temporary control and reinvest the proceeds in U.S. Treasury bonds, with maturities matching the scheduled dates for distributions. That strategy would leave the fiduciaries immune from both public criticism and the possibility of personal liability for failure to act in accordance with the prudent man standard. I myself feel comfortable that Berkshire shares will provide a safe and rewarding investment during the disposal period. There is always a chance, unlikely but not negligible, that events will prove me wrong. I believe, however, that there is a high probability that my directive will deliver substantially greater resources to society than would result from a conventional course of action. Key to my Berkshire-only instructions is my faith in the future judgment and fidelity of Berkshire directors. They will regularly be tested by Wall Streeters bearing fees. At many companies, these super salesmen might win. I do not, however, expect that to happen at Berkshire. Boards of directors. In recent years, both the composition of corporate boards and their purpose have become hot topics. Once, debate about the responsibilities of boards was largely limited to lawyers. Today, institutional investors and politicians have weighed in as well. My credentials for discussing corporate governance include the fact that, over the last 62 years, I have served as a director of 21 publicly owned companies, listed below. In all but 2 of them, I have represented a substantial holding of stock. In a few cases, I have tried to implement important change. During the first 30 or so years of my services, it was rare to find a woman in the room unless she represented a family controlling the enterprise. This year, it should be noted, marks the 100th anniversary of the 19th Amendment, which guaranteed American women the right to have their voices heard in a voting booth. Their attaining similar status in a boardroom remains a work in progress. Over the years, many new rules and guidelines pertaining to board composition and duties have come into being. The bedrock challenge for directors, nevertheless, remains constant. Find and retain a talented CEO, possessing integrity, for sure, who will be devoted to the company for her business lifetime. Often, that task is hard. When directors get it right though, they need to do little else. But when they mess it up, audit committees now work much harder than they once did, and almost always view the job with appropriate seriousness. Nevertheless, these committees remain no match for managers who wish to game numbers, an offense that has been encouraged by the scourge of earnings, guidance, and the desire of CEOs to hit number. My direct experience, limited thankfully with CEOs who have played with a company's numbers, indicates that they were more often prompted by ego than by a desire for financial gain. Compensation committees now rely much more heavily on consultants than they used to. Consequently, compensation arrangements have become more complicated. What committee member wants to explain paying large fees year after year for a simple plan? And the reading of proxy material has become a mind-numbing experience. One very important improvement in corporate governance has been mandated: a regularly scheduled executive session of directors at which the CEO is barred. Prior to that change, truly frank discussions of a CEO's skills, acquisition decisions and compensation were rare. Acquisition proposals remain a particularly vexing problem for board members. The legal orchestration for making deals has been refined and expanded, a word aptly describing attendant costs as well. But I have yet to see a CEO who craves an acquisition bring in an informed and articulate critic to argue against it. And yes, include me among the guilty. Overall, the deck is stacked in favor of the deal that's coveted by the CEO and her obliging staff. It would be an interesting exercise for a company to hire 2 expert acquisition advisors, one pro and one con, to deliver his or her views on a proposed deal to the board, with the winning advisor to receive, say, 10 times a token sum paid to the loser. Don't hold your breath awaiting this reform. The current system, whatever its shortcomings for shareholders, works magnificently for CEOs and the many advisors and other professionals who feast on deals. A venerable caution will forever be true when advice from Wall Street is contemplated. Don't ask the barber whether you need a haircut. Over the years, board independence has become a new area of emphasis. One key point relating to this topic, though, is almost invariably overlooked. Director compensation has now soared to a level that inevitably makes pay a subconscious factor affecting the behavior of many non-wealthy members. Think, for a moment, of the director earning $250,000, $300,000 for board meetings, consuming a pleasant couple of days 6 or so times a year. Frequently, the possession of one such directorship bestows on its holder 3 to 4 times the annual median income of U.S. households. I missed much of this gravy train. As a director of Portland Gas Light in the early 1960s, I received $100 annually for my service. To earn this princely sum, I commuted to Maine 4 times a year. And job security now? It's fabulous. Board members may get politely ignored, but they seldom get fired. Instead, generous age limits, usually 70 or higher, act as the standard method for the genteel ejection of directors. Is it any wonder that a non-wealthy director, NWD, now hopes, or even yearns, to be asked to join a second board, thereby vaulting into the $500,000, $600,000 class? To achieve this goal, the NWD will need help. The CEO of a company searching for board members will almost certainly check with the NWD's current CEO as to whether NWD is a good director. Good, of course, is a code word. If the NWD has seriously challenged her present CEO's compensation or acquisition dreams, his or her candidacy will silently die. When seeking directors, CEOs don't look for pit bulls. It's the Cocker Spaniel that gets taken home. Despite the illogic of it all, the director for whom fees are important, indeed, craved, is almost universally classified as independent, while many directors possessing fortunes very substantially, linked to the welfare of the corporation, are deemed lacking in independence. Not long ago, I looked at the proxy material of a large American company and found that 8 directors had never purchased a share of the company's stock using their own money. They, of course, had received grants of stock as a supplement to their generous cash compensation. This particular company had long been a laggard, but the directors were doing wonderfully. Paid with my own money, ownership, of course, does not create wisdom or ensure business smarts. Nevertheless, I feel better when directors of our portfolio companies have had the experience of purchasing shares with their savings, rather than simply having been the recipients of grants. Here, a pause is due. I'd like you to know that almost all of the directors I have met over the years have been decent, likable, and intelligent. They dressed well, made good neighbors, and were fine citizens. I've enjoyed their company. Among the group are some men and women that I would not have met except for our mutual board service and who have become close friends. Nevertheless, many of these good souls are people whom I would never have chosen to handle money or business matters. It simply was not their game. They, in turn, would never have asked me for help in removing a tooth, decorating their home, or improving their golf swing. Moreover, if I were ever scheduled to appear on Dancing with the Stars, I would immediately seek refuge in the Witness Protection Program. We are all duds at one thing or another. For most of us, the list is long. The important point to recognize is that if you are Bobby Fischer, you must play only chess for money. At Berkshire, we will continue to look for business-savvy directors who are owner-oriented and arrive with a strong specific interest in our company. Thought and principles, not robot-like process, will guide their actions. In representing your interests, they will of course seek managers whose goals include delighting their customers, cherishing their associates, and acting as good citizens of both their communities and our country. Those objectives are not new. They were the goals of able CEOs 60 years ago and remain so. Who would have it otherwise? Short subjects. In past reports, we've discussed both the sense and nonsense of stock repurchases. Our thinking boiled down. Berkshire will buy back its stock only if A, Charlie and I believe that it is selling for less than it is worth, and B, the company upon completing the repurchase is left with ample cash. Calculations of intrinsic value are far from precise. Consequently, neither of us feels any urgency to buy an estimated $1 of value for a very real 95 cents. In 2019, the Berkshire price-value equation was modestly favorable at times, and we spent $5 billion in repurchasing about 1% of the company. Over time, we want Berkshire's share count to go down. If the price-to-value discount, as we estimate it, widens, we will likely become more aggressive in purchasing shares. We will not, however, prop the stock at any level. Shareholders having at least $20 million in value of A or B shares and an inclination to sell shares to Berkshire may wish to have their broker contact Berkshire's Mark Millard at 402-346-1400. We request that you phone Mark between 8 to 8:30 a.m. or 3 to 3:30 p.m. Central Time, calling only if you are ready to sell. In 2019, Berkshire sent $3.6 billion to the U.S. Treasury to pay its current income tax. The U.S. government collected $243 billion from corporate income tax payments during the same period. From these statistics, you can take pride that your company delivered 112% of the federal income taxes paid by all of corporate America. 55 years ago, when Berkshire entered its current incarnation, the company paid nothing in federal income tax. For good reason, too. Over the previous decade, the struggling business had recorded a net loss. Since then, as Berkshire retained nearly all of its earnings, the beneficiaries of that policy became not only the company's shareholders, but also the federal government. In most future years, we both hope and expect to send far larger sums to the Treasury. On pages A2, A3, you will find details about our annual meeting, which will be held on the 2nd of May 2020. Yahoo, as usual, will be streaming the event worldwide. There will be one important change, however, in our format. I've had suggestions from shareholders, media and board members that Ajit Jain and Greg Abel, our two key operating managers, be given more exposure at the meeting. That change makes great sense. They are outstanding individuals, both as managers and as human beings, and you should hear more from them. Shareholders, who this year send a question to be asked by our three long-serving journalists, may specify that it be posed to Ajit or Greg. They, like Charlie and me, will not have even a hint of what the questions will be. The journalists will alternate questions with those from the audience, who also can direct questions to any of the four of us. So polish up your zingers. On May 2nd, come to Omaha. Meet your fellow capitalists, buy some Berkshire products, have fun. Charlie and I, along with the entire Berkshire gang, are looking forward to seeing you. Warren E. Buffett, Chairman of the Board.